If you want to make a living by day trading, scalping is one of the skills you will have to master. Scalping is not difficult if you understand the market, identify the high probability setups, develop your own strategy, and stick to it. In this video, I'm going to show you everything you need to know about scalping. So let's get started. I will cover the following topics. Number 1, the scalping basics. I will show you what to trade, when to trade, and also the important rules for scalping. Number 2, the scalping strategies. Each strategy contains 4 parts. The most important part is the setup, and then I will also go through the entry, stop, and the profit target. Number 3, in the last part, I'm going to use the Bitcoin, for example, to show you how to do the scalping in the live chart. What is scalping? So simply to say, scalping is to take small profit in fast-moving and trending market. So here, you want to remember the 2 keywords, fast-moving and trending. These are the characteristics for a strong market. Basically, we classify the market into 2 categories, strong market and a weak market. And you want to scalp only in the strong market. What's the difference between them? First, for the strong market, it is always trending. You can see clear direction. However, in the weak market, it is normally in trading range. Second, in the strong market, there are a lot of high probability trades. But in the weak market, normally you will get stop out. Third, you can take quick profit in the strong market, but in the weak market, your target might not be reached. Now let's have a look at the 2 examples for the strong market and the weak market. First, the chart on the left. We can see very clearly that there are consecutive bull bars going up here, and also at the same time, there's less overlap of the bars next to each other. These 2 are the signs for the strong market. For the strong market, when it comes with the higher high, you wait for the pullback and trade the pullback. Then you wait for the signal bar, here it comes, and then you scalp. You can see that definitely you can get a profit. So in the strong market, you can see the leg up, pullback, and up. It's very clear. On the contrary, in a weak market, first we will see that there are a lot of overlaps among the bars next to each other, and also at the same time, the leg is not that clear. If you use the same strategy to wait for the lower high, and then wait for the pullback to trade the pullback, then these 2 bear bars can serve as the signal bar. However, when you put your trade through, you can see that you put your stop at the top of the pullback. In the end, the market didn't go down enough to hit your profit target. However, it gives you a stop out. For more information to identify the strong market and the weak market, I have another video, which is the Candlesticks in day trading. It is a complete course for beginner day traders, so you can have a look at that video for more details. What financial instruments can you trade on for scalping? Basically everything. So you can scalp on stocks, crypto, futures, and also currencies. However, you want to know the details of each of the financial instruments before you start the trading. Let's take this ESE Mini S&P 500 futures for example. In the table, there are 2 things you need to pay attention to. The first thing is the contract unit, which is $50 times the index level. If the index right now is at 4,000, that means you need $50 times 4,000, which is 200K, for starting the trading. However, your broker will give you a margin, let's say 5%. That means you need 10,000 US dollars to be able to trade 1 contract. Another thing is the minimum price fluctuation. That means if the market moves up by 1 tick, which is 0.5 index points, which is equivalent to 12.5 US dollars. So normally for beginner traders, 2 points for the ESE Mini is the daily target. The next question is when to trade. Some of the financial instruments can be traded around the clock. Like the currencies and the futures, they can be traded almost 24 hours from Monday to Friday, and for the Bitcoins, it can be traded 24/7. However, you cannot trade that long. So you want to find out when the market is the strongest and trade accordingly. There are a few options. First, we can trade during the exchange trading hours. Here's a table listing all the major exchange trading hours here. If we take New York time for example, first in the morning we have the London market, and then we have the New York market. In the evening we have Sydney and also Tokyo. However, most of the volumes will be happening in the New York market opening. Even during the exchange trading hours, the market is not always very strong. So you want to find out when the volume is increasing and then trade accordingly. Here's an hourly trading chart for 3 consecutive days. At the bottom, you can see the volumes. You want to trade in the hours that the volume is the highest. There is a special situation here. It is the economic event. Basically, there are examples in the table. You can see that at 2 p.m., there is an interest rate decision. This economic event will impact the US stock market or anything that's related to the US dollars. So on that day, before 2 p.m., you don't want to trade because the market will be waiting for the financial result release. If you trade before that, you could get stop out. Right after the financial result release at 2 p.m., you will see the market moves greatly. If you can capture the trend for scalping or even for swing, you're going to make a fortune. Next, what chart can you trade for scalping? Here's the table showing all the chart types. We have the second, minute, hour, or even tick and volume. However, it is recommended that the beginner day traders are using 5 minutes, 10 minutes, and 15-minute chart because you need time to make your decision whether to pull your trigger. And also on the economic event release, you can use 30 seconds or 1 minute to capture the first minute market movement. For one financial instrument, what time frame to trade on? So here's our examples. On the left, we have the 5-minute chart, and on the right, we have the 15-minute chart. You can check on the chart that here there's overlap between the bars for the 5-minute chart. However, on the 15-minute chart, it is clear. The same thing for the overlap here. It is not clear on 5-minute chart, but it is clear on 15-minute chart. So you can check each of the financial instruments until you see a clear chart. That is the time frame you want to trade on. A beginner may think that they want to trade lower time frame to lower their risk, like they're trading 1 minute or 2-minute charts. However, that is not the case. Basically, the position size will decide your risk. You can always reduce the position size to the level that you're comfortable with. Another way is to find out the alternative instruments. For example, the ES E-mini futures is too much for you, you can use SPY instead. For the Euro futures, you can use the currency Euro USD for alternatives. Let's move on to a very important topic, which is the risk-reward ratio. Here's the table showing all the possible scenarios. We can see that when the reward to risk is 1-to-1, we need 50% winning ratio to break even. That means for any trades that give you over 50% of win rate, we can make profit. However, if you increase your risk, for example, 2 risk against 1 reward, that means you need to win 67% of the time to break even. On the other side, if you increase your reward, you need only 33% win ratio to break even. For beginner day traders, it is not recommended to use the risk larger than the reward. And then it is preferred to use the reward to risk between 1-to-1 and 2-to-1. For the reward larger than 2-to-1, like the 2.5-to-1 or 3-to-1, they're more for swings because most of the time the market will come back for pullback. Here are some rules for scalping that you want to keep in mind. First, always trade with the trend. Beginners tend to trade against the trend because they didn't see the big picture for the whole day. Here's an example. So basically, when you see this down leg here, the beginner might wait for the pullback and then trade downward. For example, if they see there's a bear bar here, or the bear bar here, or the bear bar here, they want to go short. However, the big picture is this is the first leg up, and then this is the pullback, and then it goes up again. So for the correct trading, we need to wait for the good signal bar to go long here, here, and also here. The second rule for scalping is let the bars finish before you make any decisions. This is because your study is based on the finished bars. And also, if you make a decision to enter the market when the bar is still developing, when the bar finishes, you could regret. Here's an example. When the bar is still developing, it is a very strong trend bar. And then if you enter the market goes up as expected. However, in the last few seconds or even in the last few minutes of a 5-minute bar, it could end up something like this with a big tail at the very top. So this means a strong resistance. So the next bar could be a bear bar to hit your stop. The third rule for the scalping is to survive the pullback. So basically, what if the market doesn't go your way right after you enter the trade? There are two scenarios. If the setup is still valid, you need to hold your position. If the setup changes, you need to exit the position right away. Here's an example. The market goes down, and then your strategy allows you to wait for the pullback, which is this bull bar, and then you wait for a signal bar, which is this bear bar, and then enter the market at the bottom of this bear bar. And you put your stop at the top of the pullback here. However, the market didn't go down as you expected right away. Instead, it pulls back. So at this time, if you are afraid of being stopped out and exit your position, you will regret, because the market goes up and then it is 2 ticks below your stop here, and then the market resumes downtrend. Right now, you are having a losing trade instead of a winning trade. The fourth rule for scalping is pull the trigger whenever the setup is ready. This is because some beginner traders is afraid to trade again when they have stop outs. However, you should understand trading is a game of probability. There must be some losing trades. And also you need to control your emotions. You don't want to be over happy, upset, or angry. Any emotion could lead to losing trades. In the end, if you have a few stop outs in a row, you really need to stop trading because there must be something wrong, either your strategy or maybe because of your emotions. Here's an example. We have a down leg, and then you're waiting for the pullback, which is this bull bar, and then here comes the signal bar, this bear bar, and you enter the market with a stop at the top of the pullback. However, you can see that the market goes back to stop you out. A few bars later, we can see this bull bar with a big tail at the top. That means the market could resume the downward. And then when you see this signal bar, you should be able to pull your trigger again to trade downward. And then in the end, you can see from the chart, you never get stop out, and then the market comes with another signal bar here. You can trade again to add up your position. Then the market goes down. So this signal bar and this signal bar, you should take the chances to put your position there to enter the market. Otherwise, you're going to end up with a one losing trade. Study of the historical charts and the daily homework are very important. Here's an example. You want to have a table with the statistics on the winning and losing trades for each of the setups here. You want to understand the win ratio for each of them and then how many P&L they can give you so you can trade accordingly. Another thing is that you want to develop your own strategies rather than using others directly, because if you use others, that means you don't have a good understanding of what the strategy is, and then you will end up losing. The next is you want to learn from your losing trades, even though looking at the losing trades is going to hurt because you're losing money. However, you should really understand why you're losing, whether it is because of your strategy or because you didn't control your emotion. Otherwise, you're going to have the same losing trade again and again. The last part for the scalping basics is to trade paper account until you're profitable. This is because you need the paper account to test your strategy. And also in the real trading, you need to learn how to pull your trigger to trade different orders. And then you can move to the live account with a small position if you feel comfortable. Lastly, so whenever you see there's any issue with your live account trading, you need to move back to paper account to avoid further losses. Now let's move on to the most exciting part, the scalping strategies. So for any strategy, there should be at least 4 parts: the setup, the entry, the stop, and the profit target. And among the 4 parts, setup accounts 90% of the success. So if your setup is good with a high probability, even if you don't manage your trade well, you won't get big loss, or you can end up with a small profit. However, if your setup is with very low probability, even if you manage your trade well, you could have more losses. There are a lot of tools that you can use for setup. You can use Trendline, support resistance, EMA, MACD, RSI, Bollinger Band, Fibonacci retracement, pivots, volume, and ATR. However, among all the tools, Trendline and support resistance are more reliable than the others. For the rest, indicators, it is better that you use them combining with either Trendline or support. There are a lot of setups that can lead to good scalping opportunities. However, in this video, I will introduce only the 3 major ones. The first one is the event breakout. Second one, trendline breakout. The third one, trendline support and resistance. Let's first talk about the event breakout. This is the GBP CAD 5-minute chart, and on that day, there's an unemployment rate release. And you can see there's a huge bear trend bar at the moment when the result is released. And also it's leading to a second leg down. What we can do is, beforehand, we want to know what date and time the event is going to be released, and then we want to study the historical chart to see which financial instrument is impacted by this event. And at the moment of the result release, we can either use 30-second chart or 1-minute chart to capture the first 5 minutes market movement, and after the first 5 minutes, we can go back to the 5-minute chart. The second setup is the trendline breakout. So basically, the market first moves between 2 lines, and then suddenly it breaks out either side with consecutive either bull bars or bear bars. And then there's a good opportunity when it pulls back, and then it's always leading to the second leg, and we can do a measure move. So we're waiting for the pullback for entry. The third setup is the trendline support and resistance. Normally, the market will move between 2 trend lines, and then when it touches either side of the trend line for the third time, there's a good trading opportunity. However, we want to trade with the trend rather than against the trend. And we can set the target to be other side of the trend line, or we can use risk-reward ratios. There are also other setups which will lead high probability trading opportunities. For example, the stairs pattern and also the trapezoid. You can search my channel for those 2 videos for more details. In terms of the entry, there are a few types of orders that you can use. The first one is the stop order. Basically, when you see the signal bar, you put your stop order at either top or bottom of the signal bar to enter the market. The second is you can use the market order. So you put the market order upon the close of the signal bar. And third is the limit order. You can put the order at the top or bottom of the pullback crossing the trend line. So I strongly recommend the beginners to use the stop order, because when you see the signal bar, which will increase the probability that the market will go to the direction that you are expecting. And also, with a lot of brokers, you can specify the stop order and the limit order attaching to an entry. So whenever either the stop order or the limit order is hit, the other order will be cancelled automatically. Now let me use an example to show you how to use different orders for entry. Let's use this trendline support and resistance setup. So basically, this is the third time that the market touches the trend line. So we're waiting for a signal bar, and then this bear bar can serve as a signal bar. So if you are using the stop order, you want to put it at the bottom of the bear bar here, so just one tick below the low of this bear bar. If you are using the market order, so when this bar is finishing, so you can hit the market order button to enter at the close of the bear bar here. The third is the limit order. So basically, you want to draw a line which is the intersection of the trend line here and also with the bar. So you put your limit order here. However, the issue is that your limit order might not be hit. There are two things about entry that I would like to bring up. The first thing is, in a fast-moving market, you could get slippage. For example, if you are trading the event breakout and then you put your order, the stop order, on top of a bull bar. However, when the market moves up, you're not going to get hit at the level. Rather, you're going to get entered at a higher level. So this is called slippage. So for the slippage, there's no good way to deal with it. And you shouldn't be changing your plan, especially the profit target, though this slippage doesn't happen a lot. Second, anytime, do not force the market to enter a trade and do not trace a trade. So basically, if the setup is not ready, don't enter. Do not force the market to give you a trade. And also, if you miss the opportunity to enter a trade, do not trace the trade, just let it go. Now let's move to the stop. So there are a few ways for you to put your stop. The first is you can use the current pullback. So in this case, you're adding your stop at the one tick above the pullback here. However, if the market doesn't go down immediately and then it goes back to test your pullback, it could give you a stop out. The second is that you can put your stop halfway between the current pullback and the previous pullback. So in this way, you give more room to the market and at the same time, you're increasing your risk. The third way is you put at the top of the previous pullback. The reasoning behind is because the market, if it goes back to test your previous pullback and even go higher, that means the downtrend is over. There are two things about a stop. First is the protective stop and an actual stop. So basically, you can use the halfway stop and the previous pullback stop as the protective stop. So the good thing about this protective stop is you give more room for the market to develop. And also, the market could really go any direction. So in case it doesn't go your way, at least you have something to protect yourself. And when the market goes your way, you want to move your protective stop to your actual stop at the pullback immediately. And then you want to measure your reward based on the actual stop rather than the protective stop. The second thing is you want to have a close position button in your trading platform. So anytime you feel that something wrong with the market, you can close your position and cancel all the pending orders immediately to reduce your loss. Now let's move on to the last part of the strategy, taking the profit. So there are two ways that you can take the profit for scalping. The first way is you can use your reward and the risk ratio. So based on your study, you can use n times the risk as your reward. N should be between 1 and 2. So take this chart for example. Your entry will be one tick below the signal bar, which is this bear bar, and then your stop should be one tick above the pullback, which is here. So this is your risk. And then if you're taking the reward the same as your risk, you're gonna take profit at this level. And if you're taking 2 times the risk as your reward, you can take the profit at this level. The second scenario is that you can use the measure move. So the basic assumption is when the market goes down for the first leg, after the pullback, the market will go down the same distance as the first leg. So take this chart for example. If you assume this is the first leg, this is the pullback, so you measure the distance from the top of the first leg down to the bottom of the first leg. And then you measure again from the top of the pullback down. So here is your profit target. So in this case, you can see that there's a small pullback here. And then you can also treat this as like a swing. It really depends on how you understand this market. So if you're using the swing, you're going to take more profit than scalping. Now we are at the last part of the video. I'm going to use an example to show you how to apply scalping in the real life trading. Take this chart for example. Initially, the market is moving down between the two trend lines. What we are doing is to wait for the market to reach either side of the trend line and see whether it is going to break or it is going to reverse. So in this part, we can see the market reached the trend line here and then didn't respect it. Instead, it breaks it a little bit. However, at that time, we're not quite sure whether it is a break or it is a simply expanding of the range. Then we can see that there's a previous range high here, and then we want to draw a line at top of it. This is the resistance line. We want to see if the market reached that line, it's going to break or not for confirmation. Later on, we see this big bull bar breaking the top trend line and then reaches the resistance level. However, it respects it a little bit. We still need to wait for confirmation whether it is going to reverse or it is going to break. A few bars later, we can see there's another big bull bar breaking this resistance level and then going up. So at that time, we are very sure that the market is going up, and then this previous resistance level becomes the support level. After the market breaks the resistance level, it becomes the support right away. And then we are waiting for a good signal bar. So here comes the bull signal bar. Then we place our entry at top of the signal bar, one tick above it. And then we put our stop one tick below the pullback. And then here is our risk. We can take the profit between 1 and 2 risk as our profit target. So here is the 1 risk level and here is the 2 risk level. So you can see the market goes up until the 2 times the risk and then it pulls back. So that means there are other traders taking the profit using the same measurement like us. And then after a while, you can see this bull bar is very good trend bar that indicates there's a high probability that the market will go up again for another leg. So we need to prepare for another scalping opportunities. And then after the pullback, we see another very good bull bar which serves as the signal bar. And then we trade again using the same technique. We put our entry one tick above the top of this signal bar and the stop at the bottom of the signal bar. We can take 1 or 2 times of the risk as our reward. Again, you can see the market reacts here by pulling back. That means other traders in the market are doing the same profit taking at 2 times of the risk. After we finish the second trade, when it pulls back, we can see that this is clearly a stairs pattern. So basically, the body of all the bars are within a rectangle, and also the whole candlestick are within an outer rectangle. This is clearly a stairs pattern, which will give you 90% of the probability that the market will go up again for another leg. However, we have already go through 1, 2, 3 legs. So this fourth leg, the probability won't be that high, and the profit target shouldn't be that much like the measure move of the second leg and the third leg. So to be cautious, we put our profit target as only 1 time of the risk. And you can see that if we use the same scalping technique, we're going to get a profit at 1 time of the risk here. And then the market pulls back. Again, other traders are taking profit using the same understanding of the market. To sum up, this is a very strong market with a very good trending. So we have 1, 2, 3 times of scalping opportunities. And you can also keep part of your position to swing to the end of the trend to take more profit. If you enjoyed my video, please don't forget to subscribe, like and comment. You can also go to my channel for more videos. Thank you. Most day traders use candlestick charts for day trading. They identify the trend pattern, figure out the good timing for entry and exit position based on their trading strategy. So understanding the candlesticks and using the candlestick charts in the right way are very important. It can help you to increase your winning ratios and avoid unnecessary stop outs. In this video, I'm going to cover the following topics. Number 1, the candlestick basics. I'm going to show you the basic knowledge about the candlesticks. Number 2, how to use the candlesticks in day trading. This is the most important part for this video. And there are 2 ways to use the candlesticks in day trading. First, identify the market strength. Normally, in a strong market, it's very easy for us to identify the setup and use our strategy to enter the trade and take profit. However, on the contrary, if the market is very weak, it's normal for you to get stop outs. Second, how to use the candlestick as signal bars. A good trend will start with a very good signal bar. However, not all the candlesticks can serve a signal bar. I'm going to show you how to find out the perfect one for day trading. Number 3, I'm going to use a trading example to show you how to do the trading using candlestick charts and how important the candlesticks play in the trading. Normally in the candlestick chart, you will see bars with 2 colors. One is green and the other is red. So in the candlestick bar, in the middle, the solid part is called body. And at the top and bottom, it's called wick or tail. Most of the time, the body part will show the strength of the market. The larger this part, the stronger the market. At the top, it is called resistance. That means that when the market goes up, the seller will push it down. And the bottom calls the support. When the market goes down, the buyers will push up. In terms of the whole candlestick, the middle part, the body, will account for 90% of the market strength. So we'll focus more on this body part. Normally, we call the green bar the bull bar and the red one bear bar. So the bull bar will start with the bottom of the body. That's the open of the bar. And then it could first go down to the low, and then it goes up to the high. And then in the end, it closes at the top of the body. This is a bull bar. That means the market is going up. It's the similar logic for the bear bar as well. Open, high, low, and close. The bear bar means the market is going down. Here's an example for the ESE Mini S&P 500 futures contract. So you will get the data from the brokers like in this format. First, the market will open at 4514.75. And then it could either first go up to the high or go down to the low. Doesn't really matter. However, in the end, it closed at the 4575.75. This data format is very important for you to remember because almost all the brokers will provide the historical data in this format. Open, high, low, and close. Another thing is that if you want to build some programming to test your strategy, you need to download the data in this format, and then you can build codes to take these 4 numbers from the table as well. In terms of the color of the candlestick, normally they are green and red. However, you can customize the colors as well. And some traders prefer the black and white. It really doesn't matter. However, using the strategy with different colors, that means you care about the direction of each bar. There are also other traders that don't like the color of the bars. They don't want to differentiate the bull bar and the bear bar. So they will use pure color like white or black. It's really based on your strategy. For two bars next to each other, there could be two scenarios. The first one is the previous close equals the current open. Here's an example. This is a 5-minute chart. For the bar at 10:30, the close is 68.9. It's the same for the open for the next bar at 10:35. The bar will be something like this. You can see that the close and the open are at the same level. The second scenario is that for the bars next to each other is that the close of the previous bar is different from the current open. Here's another example. This is a daily chart, and the candlestick at November the 9th closes at 83. However, on November the 10th, the open is 83.38, which is 38 cents higher than the previous close. You will see something like this. So there's a gap up, basically. Here are the examples of the two bull bars consecutive to each other with the previous close equals the current open. And here is the example of the consecutive bear bars, but there's a gap. Normally, if the previous close is the same as the current open, it doesn't really tell us much about the market. However, if there's a gap up or gap down, it tells us the market strength. So we'll focus more on this situation. I will talk about this later on. Why the previous close doesn't equal to the current open? There are two reasons. The first reason is the market is not continuous. Normally, it will happen on the weekly chart and the daily chart. For example, on the weekly chart, the previous bar will close on Friday for the futures market. However, the next bar will start on the evening of Sunday. So that's why in between, there's some time, there might be some news released, and the market reacts to the news. That's why there's a gap up or down. The second reason is because the market moves so fast, especially with increasing volume. So, for example, in the 5-minute chart or even the 1-minute chart, within 1 second for the next bar, the market already moves away from the previous close. That's why. And then it's a very good signal for the strength of the market. All the candlesticks can be classified into the following category. The first category is strong bars. You can see the body accounts majority of the candlestick. This is a very good indication of the strength of the market. The next category is the weak bar. You can see the body is smaller, and it really depends on where the body is. It's at the top, at the bottom, so it will give you the signal on the market direction. However, it is weaker than the strong bar. When the body gets even smaller, we could have the hammer or the inverse hammer, or there are other names from other websites. It really doesn't matter. It's just like this. And it could be the signal for the uptrend or downtrend because the tail at one side is very large. The next type is doji bar. So basically the close and the open are at the same level. So this is a very specific type of candlestick bars. However, normally doji bar won't serve as good signal bars. And if the close and open is the same as the high or low, we can also call it pin bar. So the doji bar and pin bar won't be good signal bars. We have just covered the types for the single candlestick. Now we move on to the combination of multiple candlesticks. There are 20 or 30 types of different candlestick combinations. Here we only talk about 3 of them. The first one is engulfing. So this is a bullish engulfing pattern. So basically, the first bar is a bear bar, and then the next bar is a bull bar. The bull bar closed above the bear bar, indicating the reversal of the trend. The second pattern is the morning star. So first the market goes down with a bear bar, and then it gap down with another weak bar, And then the third bar is another gap up with a bull bar. This also indicates the reversal of the market. The third type is the three white soldiers. So basically, the first bar and the second bar and the third bar, they are all bars with no wick at the top and the bottom. However, the second bar will open in the middle of the first bar. The same thing for the third bar. It opens in the middle of the second bar. These three bars indicate the strength of the market of going up. These candlestick patterns worked very well in the old days because in those times the market volume was very low and also the information was not efficient among the buyers and the sellers. However, as the technology advances, people are using computers to assist their trading. Especially the institutional investors will use computer programming, especially the high frequency trading. So nowadays, this pattern won't work very well. So I don't recommend to use these patterns. We should focus more on the signal bar, the single bar, rather than the combination of different bars. For example, this is the engulfing pattern, and then I will ask, what about this pattern? Even though it is not a perfect engulfing, however, the bull bar here is very strong. It also indicates the reversal of the market. The next pattern, the same thing. The bull bar body is larger than the bear bar body. It is also a very good signal bar for the bull bar. The next one as well. The only time we need to care about the bar before it is in this situation, that the previous bar is much larger than the current bar, like it's 2 times larger than the current bar. That means the market is uncertain, or we have to wait for the market to confirm whether it is a reversal or not. It is the similar logic for the three white soldiers. If it indicates the strength of the market, what about these two patterns? We can still see that the consecutive bull bars means the market strength, even though they have tails at the top and the bottom. We have just covered the candlestick basics. Now let's move on to the most important part of this video, how to use the candlesticks in day trading. Mainly, there are 2 ways for us to use the candlesticks. The first one is to tell the strength of the market, and the second one is to find out the signal bar. Why do we want to know the strength of the market? First, let's have a look at the issues a beginner trader normally face. Have you experienced the following? After you pull the trigger to enter a position, however, the market doesn't go anywhere. So it moves around your entry level. Sometimes you have a small profit, and sometimes you're having a small loss. And then you're not confident enough to hold your position, and then you choose to close your position, either above the entry level with a little profit, or maybe below the entry level with a small loss, or even sometimes you could get a stop out. The second scenario is when the market goes your way, you're happy, however, it doesn't go far enough to reach your profit target, and then it goes back down, and then the situation is that you could be in a loss or you could be in a small profit, and this time you will question yourself, why should I put the profit target so high? Should I just take the profit and exit the market? And then in the end, the result could be that if you manage your trade well, you could get a little bit profit or even break even, and sometimes you could end up with a loss. One of the reasons for these issues is because the market is not strong enough. So let's have a look what a strong market is. So in a strong market, first, the market moves very fast. So after you enter the trade, you will see the market goes your way right away. It won't linger for a long time. And second, in a strong market, you will see the pattern is very clear. For example, you're trading the open triangle, you're trading the wedge. So all the patterns will be very clear to you. It's tradable. Third, and then in the strong market, there will be multiple opportunities rather than just one or two. So you can re-enter your position or you can add up your position as the trend goes on. And then the fourth, so the profit target should be very easy to reach because the market is strong, and then usually it follows the measured move, and then you can take your profit as very comfortable. On the contrary, in a weak market, the weak market will have all the characteristics on the opposite side. And for the issues we mentioned before, probably you're trading in a weak market. And this is why we want to identify the strength of the market to avoid losses, because in a strong market, there are higher probability to get into a trade and take the profit. So how do we tell if the market is a strong market or weak market? So there are three ways to tell whether the market is strong. The first one is we can use a single trend bar to tell whether the market is strong. To be classified as the single trend bar, the bar has to have a body of larger than 60% of the whole candlestick. And also at the same time, this bar should be at least 2 times than all the other bars in the same screen. Let's have a look at some of the examples. Let's have a look at this chart. We can see that this bar is a very good trend bar, is a bad bar. The body is larger than 60% of the whole candlestick, and at the same time, it's at least 2 times larger than all the bars on its left. So upon seeing this big bad bar as the trend bar, you should be prepared to go short. And then after the pullback here, there's a bull bar pullback and then another bad bar. You should enter your position for short, and then the trend will go down. You can also do the measure move for your profit target. If you measure the height of this trend bar and then do the same measuring from the top of the pullback and then measure down, so the market should go down at least the same as the height of this trend bar. There's another example. On the right, we can see this bull bar can serve as a trend bar as well, because the body is larger than 60% of the whole candlestick and larger than all the bars on the left. And then after the pullback, you should find a good place to enter your trade. So in this case, the trend develops into an up channel, very strong up channel. And then again, you can use measure move. This time, you measure from the bottom of this, the first bull bar, which is the start of the trend, until the top here. And then if you do the same measurement, this channel will go up the same as the measure move. Besides the single trend bar, another way to tell the strength of the market is to use the consecutive bars. So to be able to tell the market strength, these bars should be with the same direction, and at the same time, there should be 2 or more bars consecutively. And also, these bars normally should be larger than all the other bars before it. Let's have a look at some examples. Let's use these 3 consecutive bull bars for example. So this is a very strong pattern here. The reason that this is a strong pattern is because if we take a look at the second bar here, the second bar closed above the high of the first bar. And the same thing for the third bar. The third bar closed above the high of the second bar and also the first bar as well. So this means the strength of the market. We also have a semi-strong pattern. From the chart, you can see it's similar to the strong pattern that the second bar closed above the high of the first bar. However, for the third bar, it closed above the first bar's high. However, it is not higher than the second bar's high. So still, it is very strong, though it is semi-strong. Let's have a look at the examples of real trading chart. So on this chart, you can see that the trend starts with 4 very big bull bars here. And then it means the market is very strong because, like we mentioned, the second bar closed above the high of the first bar, and then the third bar closed above the high of the second bar. And then another thing is that as the market goes on and the bars is getting larger, especially the third bar is larger than the first and second bar. Another thing is we can see the pullback here. The pullback is very shallow. It doesn't go down that far enough. That means the market is also strong. And then measure move. So if we measure from the bottom of the bull bar here, and then for the second leg up, it goes up almost the same distance. Here's another example for the downtrend. We can see that there are 5 consecutive bear bars here. And then even though the fifth bar has a very big support tail here, but it doesn't matter. It also means the market is very strong. And then after a small pullback, we can see there's a second leg down with the same measure move technique. And then it has another third leg down. Though the third leg, it won't follow the measure move. But when the third leg comes up, it means the market is very strong. The third way to tell whether the market is strong or not is to see whether there are overlaps among the bars next to each other especially, and also whether the chart is very clear. So if the bars next to each other, then less overlap, not only on the whole candlestick, but also the body part, that means the market is strong. And at the same time, if you can see clear legs of the trend, and also the pullback is very clear with less overlap, so that means the market is also very strong. Now let's have a look at some examples from the real trading chart. So this chart, we can see in the very beginning here, the market moves between the 2 trend lines here. We can clearly see that this is the leg down, leg up, leg down, up and down. And also if we check the bars next to each other, the overlap are very small. So we can see that the market should be very strong if the market breaks either the top trend line or the bottom trend line. So the end result is that the market breaks the bottom trend line and it goes down a lot. If we do a measure that the width of the whole range here, it goes down by 3 times the range width. There's another example on the right. Again, on the left here for the setup, we can see in the very beginning, we have a leg up here, then we can draw a trend line. However, the market moves up a little bit, so we have to expand the trend line for the first time. And then it goes up again here, so we have to expand the trend line for the second time. This is the indication that the chart or the setup is not clear. The market won't be as strong as enough. Another indicator is we can check the overlap of the bars next to each other. You can see here and also here, there are a lot of overlaps among the bull bars and the bear bars. They come next to each other. So this is the second indication the market won't be strong. The end result is that the market goes up to break the top trend line, and then it goes up only 1.5 times the range width. So using these 2 examples, we can see the clear chart, less overlap, will lead to strong market. We have just covered the first way to use the candlestick to tell the strength of the market. Now let's move on to the second way for the candlestick, which can be served as the signal bar. Before we move on, there are 3 principles that I would like you to take a look and then remember. First, for the trading, the setup determines the whether to trade, not the signal bar, which means the signal bar accounts only a small percentage of the whole trading practice. You shouldn't be relying only on the signal bar for your trading. Second, the signal bar indicates the timing of the start of the trend. So finding the good signal bar will increase the probability to get a winning trade. 3, the stronger the setup and the trend, the less important of the signal bar. So sometimes you have a very strong signal bar. However, if the trend is not strong enough, you won't be able to get your profit target. We can classify all the bars into 2 categories to serve as the signal bar. So the first category is the body of the bar is larger than 60% of the whole candlestick. whether the tails is above or below the body or which way is larger, it really doesn't matter. Here are some examples of the bars with 60% of the body. And here are the examples of the bars body accounts for 70% of the whole candlestick. And here we have 80% and 90%. As you can see that since the body is very big, the trend should be very strong. And then we can use them as the signal bar. The second category for the bars is those with the body less than 60% of the whole candlestick. So for these bars, we have a requirement. We prefer the bars which has a body leaning towards the trend direction. However, like I mentioned before, the better the setup, the less requirement on the signal bar. So now let's have a look at some examples. In the screen, it shows all the candlesticks with a body from 50% to negative 10% if we are doing an uptrend. One thing is the doji bar is not included here. That is because doji bar normally is not a good signal bar. That just means the market is uncertain. And second, we can see that there is a bear bar if we are trading uptrend. That is because if the setup is perfect, like a breakout, so you don't want to wait to see the bull bar before you enter the trade. You can take the bear bar like this. However, the body of the bear bar should be very small. And third, it's the same logic for the downtrend for bear bars as well. Now let me use two examples to show you what kind of bars can serve as signal bars in both weak trend and also strong trend. Let's first take a look at this chart. The market moves very slow and then there's a lot of overlaps, even though the market is still within the range of these two trend lines. We can identify the market is not strong, it is a weak trend. And when the market breaks the bottom trend line here, it didn't break much, and then it pulls back with the bear bar of a very large tail at the bottom. This is a strong support. So this can serve as the pullback. Let's take a look at the bear bars next to this pullback and then see which bar can serve as a good signal bar. So the first bear bar here has a body of 25% of the whole candlestick. So if you enter the trade below the low of this bear bar, what's going to happen is the market triggers the entry and then it pulls back here. And then the next bar, the next bear bar is this bar with 43% of the body here. So this bar is much better than this 25% bar. However, the market didn't go down enough to give you a trigger. And then the next bar is a bull bar. So after this, we have another bear bar. So the body is only 22%. And also the body is in the middle of the whole candlestick, which means the uncertainty of the market. So if you enter here again, it's going to pull back here. And then the last bar, the fourth bar here is a bear bar with 67% of the body. This bar is a very good signal bar. Like I said, any bar with body larger than 60% can serve as a good signal bar. And then you can see what happened after that is the market goes down as expected for our second leg. So comparing these four bear bars, we can definitely see when the market is not strong, it's a weak trend. So it's better that we find out the very good signal bar to enter the trade. Now let's have a look at the strong market. In this market, first, the market follows the trend lines here. And then the market breaks the bottom trend line for 5 consecutive bear bars, very strong bear bars, and then the bars are getting larger as the trend goes on. Even though there's a big support but the trend is very strong, so we can ignore this. Then we wait for the pullback. And then there's a bear bar here with the body account only 40% of the body of the whole candlestick. However, the body is leaning towards the uptrend rather than the downtrend. But it doesn't really matter since the trend is very strong. We can still trade based on this bear bar as the signal bar. We can put the entry below the low of this candlestick here and then enter the market. So basically you can see in the end this bear bar leads to the downtrend. And then the market pulls back again here with a small bull bar. And then after that we see the another bear bar with 38% of the body of the whole candlestick. This can also serve as a signal bar even though the body is only 38%, but the body is leaning towards the downtrend side. And then we enter and then you can see the trend continues. Another pullback here, this pullback is much larger. However, the signal bar is perfect because it's 84% of the whole candlestick. Then if you enter the trade for a quick scalp, then if you take the profits the same as your stop loss, and then you can get filled in this next bar. So this is a 5-minute chart. So basically if you trigger a trade at the bottom of this bear bar, you're gonna get the profit in the next 5 minutes. Another thing is that in a strong trend, you can definitely see that there are multiple entry opportunities for you to take the profit. So comparing the weak trend and the strong trend, you can see the signal bars are very important. However, in different scenarios, you should select the good signal bars. I have just talked about how to use the candlestick bars as signal bars for trading. And this is for beginner traders to increase their winning ratios. However, the professional traders would do it a little bit different. Let's have a look and use this chart as an example. If the market goes up with the first bull bar, the professional traders will put in buy order upon the close of this bar or even at the high of the bar by the market order or the stop order. As the market goes on, if they still believe the trend is very strong, they can add up their position. And when the market has a pullback here, when they see the first bear bar here, they will enter their trade upon the close of the bar, so they can use the market order. And then when the market reverses with the first bull bar, they can also add the position by using market order at the close of this first bull bar, or even use a stop order at the top of the bull bar here to enter the market. As the trend goes on, it makes another higher high here, and then when it pulls back, the professional traders will put the limit order at here, the low of this pullback. So in case the market goes down to test this pullback low, they're going to enter the market, but it's a buy order. And then again, when the market goes down here, consecutive bear bars here, what they can do is that they put the stop order at each high of the bear bar in case the market reverse. So they will move their buy order whenever there's another bear bar. So they will move from the top of this bear bar to the top of this bear bar if the market goes down here. And then when they see the bull bar here, the same thing, they can enter at the close or at the top. And then as the market goes on, there are a lot of opportunities for the professional trader to add to their position to gain more profit. As you can see that the professional traders are doing the trading differently. They don't really care about the bars, whether it is a doji bar, it is strong bar or trend bar. They just enter the market whenever the setup is still valid. However, for the beginner traders, I strongly recommend to use the strongest signal bar to enter the market to increase the win ratio. As you become more experienced, you can explore more strategies and enter the market using different orders. Lastly, let me use an example to show you how to do the day trading using the candlestick bars. In this chart, we can see the market follows the trend lines at the top and also the bottom. However, there's so many overlaps among different bars, which means the market is weak. And then for this pattern, we are waiting for the market to break either the top trend line or the bottom trend line. A while later, the market breaks the bottom trend line. And then for the bottom trend line break, we are waiting for the pullback and then to enter a short position. However, because this is a weak market, so we are waiting for a strong signal bar, which is preferred. However, we can also enter with a less strong signal bar if it also leads to good trading based on your historical study. If the probability of that kind of a bar will lead to winning trades as well, you can also enter. And then after the pullback, we can see this bull bar is the pullback, and then next to it is a bear bar. So for this bear bar, the body accounts only 31% of the whole candlestick. However, it is leaning downward. So this can serve as a signal bar, though it is not the perfect one. And then if you scalp, I mean that you enter at the low of this bear bar, you put your stop at the top of this high of this bear bar, and then to scalp the same distance for profit, you're measuring down from the entry level here, the same distance as your stop loss for scalp. And then next, the market goes down to hit your profit target. So you're having a profit right now. And then the next bar after this bear bar, we can see it is a bull bar. So without a follow-up bear bar, that also indicates that downtrend is very weak. And also another thing you can notice is that here we have a previous low here. And then this previous low, the market goes down to test the previous low, but it failed. And then it reversed up. So at this moment, the downtrend probably is over. So we are waiting for another setup. Another thing here to notice is that this bar is very strong trend bar. And if you choose to enter below this trend bar, you're going to get stopped out because the market reversed very quickly. So this is a bear trap. After that, we can see this is a V reversal shape. But at this moment, we're not sure. However, it really forms the shape for the V. So for V reversal, how to trade it? We need to make sure the market first take out the previous minor lower high here. Right now it does. And then we wait for the pullback. And then we wait for another good signal bar to enter the market. After that, we can see that there are 1, 2, 3, 4, 5, 6, 7, 8. 8 bull bars. Even though this is something like a doji bar, but the body is very small, it's still a bull bar. These 8 bull bars consecutively means the market is strong. And then the bear bar is a pullback. Here comes the good signal bar. So though the body is around maybe 30% of the whole candlestick, however, it is leaning toward the upward. So the trend is very strong. So we can enter here. After we enter the market, we need to think about the profit target. Even though there are 8 bull bars here, however, it is not as strong, so the measure move might not work. A realistic profit target is the previous high here. So because the market normally would go to test the previous high or low, like what happened here, it's testing the previous low, but it failed. And then it's going to test the previous high again. It could fail or it could just reach the target. However, given it is a V reversal and it's maybe there's a 60% of the time that it's going to hit the target. In reality, it really hits the target here and then with this bear bar. And next, after you take the profit, you will see there is another bull bar. And then this 1, 2, 3, 4, 5, 5 consecutive bars, they form a pattern of stairs. I call it stairs pattern. The characteristic for stairs pattern is that so relatively the body of the bars next to each other, they're within a rectangle, and high and lows the same time they're within a rectangle. Sometimes they are not perfect, but if the perfect one is very strong. So what the stairs pattern tells me is that 90% of the time the trend will continue, and then it will continue with a measured move. Even though the trend might not be perfect strong, like here we have the resistance at the top and then support at the bottom. And then we need to use this bar to enter the market. This is a very good signal bar. After you enter the market, you can use the measure move. How to do the measure move? We measure from the first bull bar here at the bottom until the last bull bar at the top. There must be consecutive bull bars here. And then we measure again from the bottom of the pullback and the start of the trend. This is the first bull bar, and then measure up the same distance like this height. That you can see if you enter the market here, you're going to get exit in this bull bar. And also you notice the next bar is a bear bar and then another bear bar. The reason that the market comes here and then resist is because some other traders, they're using the same technique to take the measure move as the exit. That's why. And then to sum up for this trading chart, we have 3 trading opportunities. One is short here and then 2 longs here. So from this example, you can see how we can apply the candlestick into our real day trading. If you enjoyed my video, please don't forget to subscribe, like, and comment. You can also go to my channel for more videos. Thank you. To be successful in day trading, you need to spend a large amount of time and effort in studying the market, developing your own trading plan, and executing your strategy. Before you become experienced in day trading, it is very easy to make mistakes, and some mistakes will cost you real money. Knowing what mistakes a beginner trader often makes in advance will help you to be more disciplined and to avoid unnecessary losses. This video will show you the top 3 mistakes in day trading with real examples. Let's get started. Number 1, not following own rules and strategy. Day trading is a full-time job, and the first thing to start day trading is to have your own trading rules. The trading rules should cover everything such as what setups you should trade, what the criteria is for entry, and how to manage when you are in a live trade. Here's an example. Based on your study of historical chart and data, wedge pattern always leads to profitable trading opportunities when the trendline break happens. Head and shoulders pattern always indicates the reversal of the trend to the opposite direction. Other patterns have low probability of good trades. So the rule for setup is to trade only wedge and head and shoulders patterns. However, in the real trading, when the market moves fast, you have the sense of urgency to take the trade and ignore your rule for setup. Take a look at this chart. The market develops a downtrend. After a small pullback, the market continues to go down by another big bear bar. Then you take a short position and expect the market to go down even further. Right after you entered the short position at the bottom of this bear bar, the market reverses. After a range, it reverses to an uptrend. It turned out the bear bar is a bear trap. You breached your own rule for setup and trade something that you don't understand. This is a very typical mistake for beginner day traders. You will also have trading rules on your order entry. For example, you only trigger your order after you see defined signal bars, which means you have a specific requirement on the bar body, percentage of solid part, and the size of tails on each end. Meanwhile, you don't allow yourself to chase a trade in any circumstances, because that will increase your stop loss and at the same time breach your study on the historical chart. Let's have a look at this chart. After the upward breakout, you're waiting for the pullback to finish and go long after you see a defined bull bar. This bull bar looks very good, and your strategy allows you to put a buy order at the top of the bull bar. However, you fail to pull the trigger after the signal bar finishes and the market goes up. Then you reposition your entry order at the top of the pullback range to trace the trade and get into the trade right after. The green vertical line shows the stop loss if you trigger your buy order at the top of the bull bar. The red vertical line shows the actual stop loss when you trace the trade. Your strategy is to take the profit when the market moves up the same distance as your stop loss from your entry level. The respective targets are drawn on the chart as the market goes on. You can see that your target on strategy is reached, but the target on trades is not. Instead, you get a stop loss because you did not follow your own trading rules that prohibit you from tracing the trade. Another trading rule breach is in trade management, and the most common issue is what to do if the trade does not go the way you expected right away. Basically, if the setup that you base your trade on is still valid, you need to stick to your strategy and exit your position only at a stop loss or profit target. On the contrary, if the setup changes, you need to exit your position right away, even if you have a loss. This is exactly the human psychology. Take a look at this chart. When the market touches the trend line for the third time, there's a good buying opportunity. The profit target should be either the upper trend line or the measured move based on the first two legs. After seeing this good signal bar, you should go long, and your order is triggered by the next bar. The market goes up as you expected. However, 2 bars later, the market comes back for a pullback and before you reach your profit target. Since it goes back to below your entry level, you feel nervous and pressure, and you're afraid if the market reverses to downward and hit your stop loss. The next few bars still do not go anywhere and you close your position when the setup is still valid. Right after you close your position, the market goes up as initially planned. You regret not holding it for long enough. In the end, the market reaches the trendline profit target. Then it goes even higher. If you use the first leg as the measured move, the third leg reaches the target. This is a typical issue for beginner traders that they cannot sit tight and survive the pullback when the setup is still valid. We have just covered the first mistake for day trading, and let's have a look at the second one, which is not doing daily homework. Daily homework is very important for a day trader and will help you to build a deep understanding of day trading, have the insight of the market, and maintain stable performance over time. Some beginner day traders skip daily homework and jump into day trading the next day without any idea of what happened the previous day and what to expect the next day. So the improvement in day trading is limited, and the same mistakes in day trading will happen again and again. There are mainly 2 parts for the daily homework: daily summary and the preparation for the next day. You want to make a detailed summary every day on the profit and loss, even if you did not do any trading during the day, which is quite normal. A database specifying how many ticks you have gained or lost by contract and by each financial instrument will show your past performance in the day trading for a certain period of time, based on which you will know which financial instrument has better opportunities than others, so you want to focus on them. You also need to build similar database by setup and calculate the profit and loss based on the probability of winning, stop loss, and the profit target. You want to trade only the setups that will give you profit over time and stop trading those that will give you a negative trader's equation. Meanwhile, in your daily homework, you also need to study every day's chart on the changing patterns, strength of recent market, and the daily volatility. These statistics are very important because the market is always changing, and for some period of time, one financial instrument has low volatility with no trading opportunities, while others will start big moves every day. So you want to be aware of them and develop a plan accordingly. Here is an example of the daily statistics. You want to record the details for each of the setups and all the statistics that can support your strategy. The second category for daily homework is the preparation for the next day. Some beginner day traders may ask, I already have my strategy in mind and I know how to trade. Why and what should I prepare for the next day? Actually, each day's trading session is not independent, and there are always connections with historical market movement. A lot of the times, the high and lows from the previous day, previous week, and the previous month will serve as resistance and support, so you want to have them on your chart. They will provide you with very good estimates of profit target and where the market will go. Trendline from upper time frame is also important since there are traders from other time frame that will take action for their own strategy. These traders include swing traders and long-term trend followers. Other preparation includes the time of economic events. As you review the historical chart, each financial instrument will be impacted by one or more economic result release. Normally, before the event time, the market will move slowly or abnormally because everyone is waiting for that moment. If you trade before the event, it is possible that your profit target won't be reached, or you could get a stop loss at the moment of the result release. Without knowing it, you will increase your trading risk greatly. Here is an example of the daily homework for economic events. You want to study each of the events, and especially the ones that are important and have impact on your trading. In general, not doing the daily homework is the second mistake for beginner traders. Starting now on, you want to spend half an hour at least on a daily basis to summarize your daily performance and make preparation for the next trading day. The third mistake for beginner day trader is to switch to live account for trading before even profitable in paper account. It is quite normal that with the enthusiasm and excitement, a beginner trader wants to test their strategies and become successful right away. However, sufficient practice and being profitable in paper account are critical before moving to the live account. This is because if you are not profitable in paper account, how can you expect to be profitable in live account? Especially the pressure level in paper account and the live account are completely different. Before starting the live account trading, there are 3 questions you should ask yourself. Number 1, how long have you practiced in the paper account? A couple of weeks are definitely not enough for practice. This is because market for any financial instruments moves by cycles from a few weeks to a few months or even longer. You want to make sure you have covered at least a full cycle, including a lag of trend movement and a pullback on the daily chart. So you will have an idea of all possible daily trend types. Here is an example for a full cycle. In the shaded area, you can see clearly that there's a leg up and there's a pullback. The second question is whether you're profitable enough in paper account. Most beginner day traders start day trading aiming to be able to support their living after go full-time on day trading. By calculating the total profit on a monthly basis or even quarterly basis will provide you with a good understanding on whether you can live on it. Like mentioned in the first question, you want to cover at least a full cycle of the market. Otherwise, you won't have sufficient profit and loss data to support your decision. Another reason is the market does not always move, and on some days, you won't be able to put a trade because the market moves very slowly. You want to make sure you know how many ticks or cents you need to earn on a monthly basis to be profitable enough for you, since you can simply by sizing up your order position to double or triple the profit. The third question is corresponding to the first mistakes for beginner day traders. Have you followed all your trading rules exactly? The answer must be yes before you go to live account. For example, if you see the market has a sudden move, but it is not your setup you're familiar with, but you still put a trade and earn some profit, since the profit is not based on the setup in your list, it is based on luck. This is dangerous because you won't be lucky all the time, and if you trade something that you don't understand, sooner or later you will lose money. Besides the three questions, an experienced trader will also revisit the paper account if they discover some new strategy and wants to test it, or if for a period of time they have constant loss and it is a good idea to get back to paper account for a while and find out if something has gone wrong to avoid further loss. In sum, this video covers the top 3 mistakes in day trading. First, not following own rules. Second, not doing daily homework. And the third, not profitable in paper account. Hope this video will help you improve your trading skills. If you enjoyed this video, please don't forget to subscribe, like, and comment. You can also go to my channel for more videos. Thank you. Moving average is a very important indicator in the day trading. It can show you the trend direction, the change of a trend direction, and it can also serve as the support and resistance, so you know when is the good timing for your entry. So in this video, I'm going to show you how to use the moving average in the day trading. Let's get started. I'm going to cover the following topics. Number 1, moving average basics. I'm going to show you the basic knowledge about moving average. Number 2, how to use exponential moving average in day trading. Basically, there are 2 uses of it. The first one is to use as the reversal setup. The second is to use as continuation setup. Number 3, I'm going to use 3 examples from currency, cryptocurrency, and also futures to show you how to apply EMA in day trading. So what is moving average? Moving average is when the current bar just finished the average close price for the previous unfinished bars. Here, we should pay attention to some keywords. The first one is this, just finished. That means only when the current bar is finished, the moving average for the current bar will be calculated. That means this moving average is a lagging indicator, so it doesn't have much forecasting power. This is something we need to pay attention to. The second keyword is this average close price, which means if it is average, it is a smooth of the trend. For example, if there's 1 or 2 outliers, it won't impact the moving average much. The third keyword is the number n here. So basically there are 2 implications. The first one is when n is a large number, a sudden price move won't have much impact on the moving average. However, if n is a small number, the sudden price change will have much more impact than the larger number on the moving average. The second implication is that n is a number larger than 1, so there are a lot of options for you to choose. So that's why it is very hard for you to find out the right one to fit your strategy and trading style. There are mainly 2 types of moving average. The first one is simple moving average, and the second one is exponential moving average. Let's take 10-period moving average for example. So here shows the weight for all the 10 close prices. We can see the weight for each one of them is exactly the same, so the moving average is calculated as the mean of the 10 close prices. For exponential moving average, we give more weight to the most recent bars. Here, for example, 1 is the current bar, so we give the most weight to it. This makes sense because the most recent bar close price will have more impact on the trend. This is only a demonstration of the weight here. For more details of the calculation, you can search on the internet to find out the formula for calculation of EMA. Just because of this characteristic, EMA is a better indicator than SMA in telling the market strength, so a lot of traders will be using EMA rather than SMA in their trading. We'll be using EMA as well in this video. For the number N in EMA, mostly there are some numbers that are used frequently, like 10, 14, 20, 50, and 200. So for 10, 14, and 20, most of the time they are for the short-term trending, like in the lower time frame chart, 5 minutes, 15 minutes, 30 minutes. And for 20, 50, and 200, most of the time they are used in the long-term trading, like in the chart 4-hour chart, 1-day chart, and also weekly chart. However, you can also customize of the number N in your trading strategy. It doesn't matter which number you have as long as it fits your trading style. What general information can EMA show us? There are 3 scenarios. The first one is when the price crosses the EMA from below to above and then stay above the EMA. And at the same time, this EMA curve is an upward sloping curve. This means the market is in an uptrend. On the other side, the second scenario, when the price crosses the EMA from above to below and stay below the EMA. So the EMA is having a downward sloping. This means the market is in a downtrend. The third scenario is for the trading range. If the price crosses the moving average multiple times, so the EMA is staying as a flat curve, so that means it is a trading range. However, even if we don't have the EMA curve here, by just telling the higher high, higher low, or lower high, lower low, we can also identify the trend. Let's move on to the second part of this video, how to use EMA in the day trading. There are mainly 2 ways. The first way is to use as the reversal setup, and the second is to use as the continuation setup. Let's first take a look at the reversal setup. So for this setup, we need 2 EMAs. One is the short-term EMA. Here we use the 10-period EMA. The other is long-term EMA. We use the 40-period EMA. So the concept is like this. So when the short-term EMA crosses the long-term EMA from above to below, that indicates the trend changed from upward to downward. So here's a good example that after the crossing here, the market moves to a downward trending. It is the same situation that when the shorter EMA crosses the longer EMA from below to above, that could indicate a trend change from downward to upward. Now let's move on to the trading range. So here we have a downtrend, and then we have multiple crosses here. Here is one, another one, the third one, and the fourth one. However, we can see that in the whole chart, it is in a trading range rather than a trending. If you enter a trade, there's a possibility that you could get stop loss rather than getting a profit. So this is one of the drawbacks to use this reversal setup. Now let's have a summary of the reversal setup. There are 2 things. The first thing is, in this reversal setup, we need 2 EMAs. That means we need 2 parameters. So whether you choose 10 and 40 or 20 to 50, it's hard to decide. It really based on your back testing. However, even if you have 10-40 for the first half of the year, but in the second half of the year, it may not work well. So that it decreases the probability of winning trade. Second, so we can see the market is not always in trending, and most of the time it's in the trading range. And the 2 periods of moving averages cross each other will reduce the probability of giving you a good indicator for trending. So that's why this reversal setup is not suggested to be used by the beginner day traders. The second setup is the continuation setup. Here, the EMA acts as the support and resistance. There are 3 scenarios. Let's take a look at this chart first. So it is an uptrend here, and then it pulls back. The market touches the EMA, and then we see this bull bar as the signal bar to enter the market. And then as the market moves on, you can see it pulls back again to touch the EMA again. So we can find out the signal bar like this bull bar and also this bull bar to enter the market. The second scenario is when the market crosses the moving average. Let's take a look at this chart. The market moves up and then it pulls back. So we can see the signal bar, this bull bar, and also this bull bar, they are across the EMA. And the same thing here. So the market pulls back again, and then this signal bar is across the EMA. So we can enter at the top of the bull bar to enter the market. The third scenario is the market penetrates the EMA. So here's the example. The market goes up and then pulls back here. So all the bull bars as the signal bars are below this EMA. But they can also serve as signal bar for you to enter the market. Another thing you should notice is that you can adjust the number N to make the EMA either it is touch, across, or penetrate. So it really depends on your strategy and based on your backtesting. For EMA in the continuation setup, there are two scenarios. The first scenario is if there are other indicators or other setups, then this EMA is a very good confirmation to the start of the trend, which will increase the probability of the trend start. And the second is that if there's no other existing techniques or tools or indicators, you can use the EMA alone as the support and resistance. And then this will also increase the probability of the trend start. And this, the second scenario, is the true value of the EMA. And I will show you in the following examples. Now let's move on to the last part of the video, the EMA examples. Let's first take a look at this GBP and CAD. Here we have a trendline break, and then we'll wait for the pullback to trade until we see a signal bar. Here comes the bull signal bar. However, it didn't get triggered. Here's another one. It didn't get triggered. The reason that we can use this bar as the signal bar is because there are 7 consecutive bull bars here, which means strong market. So the requirement for the signal bar is not that much. And then the market comes down to the EMA as the support here. It crosses a little bit. So this bar is a very good signal bar as well. And then this time the market triggers and then goes upward. However, if you look at this chart differently, we can notice there's a previous high. And then if we draw a horizontal line here, this line can serve as the support or resistance. So basically the previous high-low can do the same thing like a support and resistance for the following market. And here the market comes down to touches the support line and then resumes. We can definitely see that the market comes down here, touches the support line, and also at the same time it is touching the EMA here. That means EMA here serves as the confirmation of the start of the trend. Now let's have a look at the second example, the Bitcoin. The same situation. We have a trendline break here, and then we wait for the market to go back to the EMA as the resistance. Here comes 2 very good signal bars here, and then the market resumes downward. However, if we take a look at this chart from another angle, we can say that this trend line also serves as the support or resistance level as well. The market comes back to test this resistance as the trend line, and then it failed, so it moves downward. And the EMA here can serve as the confirmation for the start of the trend or the start of the entry. Here comes one question on these 2 examples. If we remove the EMA from the chart, can we still trade and capture the market? The answer is yes, because trendline and the support resistance levels are more reliable than EMA. However, the role EMA plays here is as the confirmation of the trend start. So you can see the percentage of EMA plays in this trade is not that much. Now let's have a look at the third example, which is the ES E-mini S&P 500 futures. Again, we have a strong breakout here, and then we're waiting for the pullback to trade upward. And you can see the market goes down here to touch the EMA, and then this bar can serve as a very good signal bar. And at the same time, for the second pullback, these two bull bars can serve as the signal bar as well. And then this time, the EMA acts as the support. The difference between this example and the previous two examples is that in this chart, there's no other indicators like the trend line or the resistance and support from the previous high-low to act as the support for this signal bar, purely using the EMA here. So this is what I mentioned as the true value of this EMA in the day trading. Another thing to mention is that, let's say for this bar, right now we are seeing it's touching the EMA. However, in the real-time trading, when the bar is still developing, you won't see it's touching. For some platforms, you won't see the EMA is under this bar, and for other platforms, you will see that the EMA here will be changing based on the bars developing. However, based on your experience, you can forecast whether it's gonna touch the EMA, across the EMA, or below the EMA. So you can make a decision on whether you want to enter. If you enjoyed my video, please don't forget to subscribe, like, and comment. You can also go to my channel for more videos. Thank you. Trendline is a simple and reliable tool because markets always moved in cycles of trending, consolidating, trending, and consolidating. Trendline can clearly show the market structure, and it has a high probability to show the start of a trend. Therefore, Trendline has forecasting power, and this is why Trendline is widely used in trading. And as a beginner day trader, you need to master the Trendline trading skills. So in this video, I'm going to show you everything about Trendline. Let's get started. I'm going to cover the following topics. Number 1, the Trendline basics. I'm going to show you different types of Trendline and how to draw a Trendline. Number 2, how to use Trendline in day trading. Basically, there are two ways. The first way is to use the Trendline as a support and resistance. And the second way is to trade the Trendline breakout. Number 3, in the last part of the video, I'm going to show you some trading examples using Trendline. What is a Trendline? To answer this question, we have to answer another question first. What is a trend? As we all know, there are two types of trends, the uptrend and the downtrend. And the definition for uptrend is to have higher highs and higher lows. And the definition for downtrend is to have lower lows and lower highs. The concepts are very simple. However, they are very easily to be ignored in the real day trading. Let's have a look at this chart. There are a lot of highs and a lot of lows. However, when we define the trend, we only use this high, this low, this lower high, and this lower low. So we call the blue ones the major highs and major lows, and the yellow ones the minor highs and minor lows. When we define a trend, we only use the major highs and the major lows. And then here comes the definition for trendline. So trendline is the line to connect major highs and major lows as the trend develops. Here, the keywords are major highs and the major lows. How to draw the trend line? Based on the concept, we need to connect the major highs and major lows. In this picture, we have an uptrend. We also have the minor highs and minor lows, though they could be on the trend line, but it's not necessary. Another thing is that we need to concentrate on the big picture. I mean the chart on your whole screen. No matter if you are trading 5 minutes, 15 minutes, 30 minutes, or 1 hour chart. We need to use the major highs and lows for your whole screen. Second, to draw the trend line, we need to fit most of the highs and lows. So here's an example. For this low, the trend line is at the bottom of the tail. And for these two highs, it is crossing the tails. So really doesn't matter as long as we can fit most of the highs and lows, no matter it is touching or it is crossing the body or tail. In an ideal situation, we should have the high-low pattern. However, in the real day trading, it is not always the case. Here's the example. We have the minor high and minor lows here. We can also have a trend line. So we need to be a little bit flexible when we do the day trading and draw the trend line. Sometimes you will see the single touch of the trend line, like the two highs here, and sometimes you will see a consolidation of the market approaching the trend line. It really doesn't matter because for the consolidation, if you take to an upper time frame, it is just a single touch. In the previous examples, we have the trend lines on both sides of the market. However, it is not necessary. Here's an example of the trend line of only one side. We need to update or expand the trend line as the market develops. Here's an example. First, we draw the trend line like this. However, as the market develops, the previous trend line doesn't work anymore, so we draw the second trend line. And then we draw the third trend line. So in the end, you can see the market follows the third trend line here. To apply the trend line from an upper time frame on a lower time frame, it is better to treat the trend line from upper time frame as a band. Here's an example. The top chart is the 4-hour chart, and the bottom chart is the 15-minute chart. You can see that if we use the upper time frame trend line as a value zone or a band, it will be more reasonable to see the behavior approaching the trend line. We also want to combine the trend lines from both upper time frame and lower time frame together to assist our day trading. Here's an example. At upper time frame, we have trend lines with a downtrend. However, in a smaller scale, we also have the breakout here with the lower time frame uptrend. Then we know we can have a short position ready there. And also here we have a market touching the bottom trend line of upper time frame. That's why the market goes back up. There are a lot of tools out there for the beginner day traders to use for day trading. Trendline is one of them, and the trendline is one of the most powerful and reliable one. Support and resistance levels are also reliable because they are also human behaviors. Support means there are buyers coming in, and resistance means sellers are coming in. There are other indicators, thousands of them. However, most of them are lagging indicators. That means they don't have much forecasting power, but they are very good indicators for confirming the trend start. You can also use computer models, but it takes time and effort. And also, one of the biggest issues for the computer models is the curve fitting. Now let's move on to the second part, the trend line in day trading. Mainly, there are two ways to use the trend line. The first one is to use the trend line as the support and resistance levels. And the second is to use the trend line breakout. Let's first take a look at the trend line support and resistance with one side of the trend line. Basically, after you have a trend line drawn, you want to trade when the market comes to the trend line for the third touch or for the fourth touch. However, the third touch will give you the highest probability. There might be fifth or sixth touch. However, the probability will be very low. In terms of the profit target, it should be very realistic. That is because there's no other trend line at the top. It's hard to decide where the trend will go. In this example, if you trade the third touch, it is not realistic if you put your profit target at the top of this high. And also for the one side of the trend line, it's better that you trade with the trend rather than against the trend. That is because when the market goes up, it's hard for you to decide when it's going to reverse. For the trend with two sides of the trend lines, the same thing, we can trade the third time and fourth time touch. In this example, we have short opportunities here, and we also have buy opportunities here. In terms of the profit target, since we have two lines here, we can set the profit target to be the other side of the trend line. If the trend line have a wide range and also the trend is not steep, there are two ways of trading, both long and short. However, if the trend is very steep, you should only trade with the trend direction. For example, here, we have the third touch and the fourth touch. They are very good long opportunities. However, if we want to short, the market will go make another higher high, so you could easily to get a stop loss. Let's move on to the trendline breakout. There are two scenarios. The first scenario is the trend line will break out to the opposite of the trend direction. For example, here, we have a downtrend, and then we have a breakout, and then it goes upward. So in this case, first, when the trend break out the trend line, and then we wait for the pullback, and then we trade the second leg up, or we trade for the third leg up. The good thing for this is that you can set your profit target as the measure move. So basically, you measure the first leg, and then expect the trend will go to the same distance for the second leg, or even for the third leg. The second scenario is the breakout can go to the same direction. The same thing, we wait for the pullback and trade for the second and third leg. This is the example. Here's a downtrend. However, the market breaks the bottom trend line. After it pulls back, it goes down for the second leg or possibly the third leg. The same thing for the profit target. We can use the measure move for the profit target. Now let's move on to the last part of this video. Let me use some examples to show you how to trade the trend line. Take this for example. First, we can see that the market is going down. Here comes the third time of the touch. However, we are in a downtrend, and then if you want to trade the upward, that means the probability will be low. Second, if you see the chart here, this part, there are a lot of overlaps of the bars, which also means the market is not strong, which also means the probability of this long will be low. So for beginner traders, it's recommended not to trade against the trend. As you become more experienced, you can definitely trade this. So let's make this part a little bit bigger. We are waiting for the pullback and then wait for the bull signal bar. Here comes one. However, this signal bar is weak because the body accounts roughly 30% of the whole candlestick. And then for the next bar, it's also a bull bar. And though it is a hammer, however, the two bars combining together means the market strength for going up. So you can trade at the top of these bull bars. The market will go up. However, you should expect the market to come down to test the low. That is because, first, it is a downtrend, you go long. Second, the bull bars here are not strong enough. After you enter the market, you can see it comes back to test the low for two times. Here's the first time, here's the second time, but they also failed. And then market goes up to touch the top trend line. So in terms of the profit target, there are two options normally. The first one is you use n times the risk, which is based on back testing of all the historical charts in the same situation. The second is the top trend line. Here it reaches the top trend line, you can see. Another thing for the this leg up is that this part, you can see there are a lot of overlaps as well, which means the buyers are weak. When the market comes to the top trend line, the third touch, there's a short opportunity. So basically, we are waiting for the market to reverse to the downtrend for a signal bar and enter the market. Let's make this part bigger. So basically, you can see there's a bear bar here. However, the bear bar is weak. And then the next bar is also a bear bar. Basically, two bear bars means the strength of the selling side. So you can enter the market at the bottom of the two bear bars here. However, you can see the next bar here, it didn't pierce your entry levels. So you didn't enter the market right after these two bear bars. And then the market goes back to test the top trend line again, and then it reverses. After this bull bar testing the top trend line, the market comes down with a very strong signal bear bar. This signal bar is strong because the body accounts for over 60% of the whole candlestick, and then you can trade downward. After that, the market comes down to test the bottom trend line. Again, your profit target could be n times of your risk, or you can set the bottom trend line as your profit target. Another thing you should notice is that the downward trend is quicker than the upward trend here. Now let's move on to the trendline break examples. Here's the break of the trendline. We can see that the breakout is strong. That is because we have 6 consecutive bull bars breaking the trendline. And also, the trend is breaking the previous major high here. It's higher than this high. That's why the breakout is strong. For the trendline breakout, we're waiting for the pullback to trade the second or the third legs. So here, we can see there's a signal bull bar here. That is because this signal bar is testing the previous minor high here, and then it pulls back. That's why you can enter the market upon the close of this signal bull bar and then put at the top of the high of the bull bar. However, the market didn't go up immediately. Instead, it comes back to test this trend line again. So there are the second and the third signal bars. Those are also good signal bars for you to enter the market. In terms of the stop loss, you can use the previous pullback here as your stop loss, or you can even use the bottom of the channel. Really doesn't matter. These are the protective stops. As the market goes up, you should put your stop at the pullback bottom here. This is your actual stop for you to measure your risk. In terms of the profit target, there are 2 options. First is you use n times your actual risk, which should be based on your backtesting of the historical charts. The second is the measured move. Basically, here's the first leg up, the 6 consecutive bull bars. We measure from the bottom of the first bull bar until the top of the last bull bar. And then we measure again from the pullback and then the same distance. You can see that the measured move ends at this bear bar. That's because there are other traders using the same measured move mechanism to take profit. That's why the market pulls back a little bit there. As the market continues to go up, you can trade for the third leg. How you identify the pullback for the third leg? First, you can use the 3 pushes pattern. Basically, you can see that this leg up, there's one push with a bear bar, second push, and the third push, and then the market resumes up. The same thing for this pullback. The first push, the second push, and the third push, and then market resumes. So the same thing for this pullback. We have one push down, second push down, and the third push down. So after the third push, you can enter the market at this bull bar here. Another thing is, because we don't have any resistance and support level on the left to serve as the reference, we can use the EMA. So here's the 10 periods EMA that you can see the market comes back to the EMA and the EMA acts as the support. So that's a good timing for you to enter the market as well. On how to use the EMA, I have a video in my channel so you can search for reference. Most of the trendline breakouts will lead to very good trending. So for this example, there's a very good trend. You don't want to scalp. Basically, you want to scalp and swing at the same time to take more profit. So one of the ways that you are using the scalp and swing is after you enter the market at this pullback, you can target half your position at 1 time of the risk, and then another 1/4 at 2 times of the risk, and then swing the rest of the 1/4 of your position to the end of the trend. So in this way, at least when you take half of your position off at the one time of the risk, and then you can put your stop loss immediately to your entry level to make sure that you're not losing anything in this particular trade. So not losing is very important to the beginner day traders. If you enjoyed my video, please don't forget to subscribe, like, and comment. You can also go to my channel for more videos. Thank you. Support and resistance are one of the most important things in day trading. Most institutional investors and professional traders are trading support and resistance because they show the human behavior and also they show the market structure. So mastering the support and resistance in day trading is the key to your success as a beginner day trader. In this video, I'm going to show you how to identify the support and resistance and how to trade them. Let's get started. I'm going to cover the following topics. Number 1, the support and resistance basics. I'm going to show you what levels can be served as the support and resistance. Number 2, how to use the support and resistance in day trading. There are mainly 3 ways. The first one is for the level boundary reversal. And the second one is the level breakout. And the third one is serve as the profit target. In the last section, I'm going to show you some examples in day trading. What are the support and resistance levels? So basically, the support and resistance levels are the horizontal levels and the value zones. Here, the level and value zone are interchangeable. So there are 2 scenarios. The first one is the market goes to a price level and then it bounces back quickly. That defines a support and resistance level. Second, when the market goes to a price level and it consolidates for a while, and then there are 2 results there. The first one is the market can continue the previous trend direction, or the market can reverse to the opposite direction. Both results will also define the support and resistance levels. How to identify the support and resistance levels? There are few scenarios. The first one is you can use the previous day's high or low. So in this chart, we can see yesterday we have a high, and then we can draw a level across the high horizontally. And then in today's chart, we can see right after the open, the market goes up to test the high. The first time, it failed. And then the second time, it also failed. And then the market goes up again to break this level here. And then it succeeds. And then the market goes back to test this level again. So clearly you can see the previous day's high and the low can serve as a very good support and resistance levels. We can also use today's previous high and low as the support and resistance levels. Here's an example. The market opens and then goes up, make a high here. And then it goes down, make a low here. Then we can draw horizontal levels on the high and the low. And then we can see the market later on goes up to retest the highs here. And also it goes down to retest the low here. So today's previous high and low can serve as the support and resistance levels. Today's previous consolidation can also serve as the support and resistance levels. Here's an example. After the market opens, it goes down here and then it consolidates a little bit. Then we can draw a horizontal level across the consolidation. Then the market goes down and goes up, ignore this level. And then here you can see that it's testing today's previous high. And then the market goes down. Here, it retests the consolidation, the first time and the second time. So you can see previous consolidation in today's chart can also serve as the support and resistance levels. Highs and lows from days ago can also serve as the support and resistance. Here's an example. 2 days ago, we have a high, and we can draw a horizontal level. Yesterday, you can see the market goes up to test this level. Here's the big tail here. That means it's testing the level. However, it succeeds, and then it goes up to penetrate this level. And this level is also recently visited. Today, after the market open, it goes down to test this level again. So highs and lows from days ago sometimes can also serve as the support and resistance levels. Levels or value zones with multiple touches from multiple days are also very good support and resistance levels. Here's an example. On some day, there's a low, and then we can draw a horizontal value zone. You can see that the following days, it's been touching this level and a value zone for multiple times. And then that means the market respects this value zone and the level very much. The more touches, the stronger the support and resistance levels. Pivot levels and pivot points are also good support and resistance levels. For how to calculate the pivot points or more information, you can search online. And most of the broker platforms will provide this indicator, so you can just set it up very easily. So here's an example. We have this R1 level, and we also have this S1 level. Yeah, you can see the market goes down to test this S1 level for 2 times. And then it goes up to test this R1 level for 4 times. So we can use the pivot levels as the support and resistance levels as well. Sometimes the market open can also serve as the support and resistance levels, especially the London and New York open. Here's an example. Here's the London open bar. And then if we draw a horizontal level, we can see that the market later on go back to test these levels for 2 times. Numbers are also very good levels. For example, for Euro USD currency, 1.3400 definitely will be a very good support or resistance levels. For Bitcoin, 46,000. For ESE Mini S&P 500, 4,500 points. Like a crude oil, $60, or the Tesla, $1,000. These are also the some target for the institutional investors because they're not seeking the profit actively, but they're hedging their positions. So these levels will be very important for them. There are a few rules when we trade the support and resistance. Number 1, the support and resistance levels can swap their position, which means the previous support level can become resistance levels later on. Number 2, it's better to apply the value zone rather than just a single line, especially when you're trading the higher time frame. Number 3, you need to draw the levels in advance because that will help you define your profit target and also see when the market will go. Number 4, we need to observe the behavior around the levels because when the market goes to a level, it can reverse or it could penetrate. Number 5, to be conservative when we trade the support and resistance because occasionally the support and resistance might not be reached. Number 6, we need to put more weight on the most recent levels rather than the levels from a while ago. Support and resistance levels are very important in day trading. However, we also have other tools. Let's have a look at the comparison between the support and resistance with other tools. The first one is the Trendline. Basically, both support and resistance levels and the Trendline are very reliable. If we combine them together, they will be very, very powerful. Also, we have other indicators, but most of the indicators are secondary and they are lagging, which means they don't have much forecasting power. However, they can work as the confirmation well, especially when the support and resistance levels and trend line do not work well or they do not appear to be on the chart. In this complete course series, I have a video on the trend line and also a video on the moving average that you can reference. Now let's move on to the second part, how to use the support and resistance in the day trading. There are mainly 3 ways. Number 1, we can trade the level boundary reversal. Number 2, we can trade the level breakout. And number 3, the support and resistance levels can serve as the profit target. Let's first take a look at the boundary reversal situation. Basically, the market most of the time is in a trading range, as we can see on this chart. And also, there should be multiple touches for the support and resistance. In this chart, we can see that the market makes 3 lows here and also 2 highs here. If we draw the horizontal levels, we can see that the market is on a parallel trading range. And then when the market goes down to touch either side of the support or resistance levels, there will be good opportunities the market can bounce back. So here, example, the market goes down, touches the support line, and then it bounces back. So there's a long opportunity. Again here, there's another long opportunity. And then when the market goes up to touch the top resistance levels, it's going to be a short opportunity. Here is one, and here's another one. And also, we can use the most recent touch as the reference to observe the market behavior. For example, for the short here, we can see it's touching the zone quite a few times and then reverse. So it happens here again. The same thing here, it's not bouncing immediately back. So we can also expect the market have the same behavior. It is very important when the market reaches the support or resistance levels, we observe the price action for confirmation whether the market can reverse or not, because the market can really penetrate the support or resistance levels. Another thing is about the profit target. If we can clearly see the support or resistance levels, we can set the profit target to be the other side. Otherwise, we can use the realistic ones like n times the risk you have. And another thing is that even if we have clearly see support or resistance levels on the other side, it's possible that the market cannot reach it. So your profit target should be very realistic. Another scenario for the boundary reversal is the support and resistance position swapped. So basically we can see that the market makes 3 highs here, so it becomes a resistance level. When the market goes up here again, we can see this bear bar with a very big tail at the top. That means the market here respects this resistance level a little bit. However, later on, it penetrates the level. And then when the market comes down here, you can see that it tested this level again. So this level becomes a support level. Then when the market goes up and goes down again to test this level again, there will be a good long opportunity here. Basically, we have to see a recent visit of the same support or resistance level before we can reach the decision that there's a go long opportunity. And then from the whole chart, we can see that it's definitely trading range behavior. Again, it is very important that we wait for a very good signal bar. So here comes a very good bull bar here. Then that means the market reversed. And in terms of the profit target, because there's only one support or resistance levels, we don't have the other side. So we can use the previous high or low as the profit target. So in this case that you can see the market goes up here to test this high. However, it didn't go to the top of this high. So the realistic profit target could be the close of this bear bar or this bull bar. Now let's move on to the level break situation. In this chart, we can see that there are 2 lows here. Then we can define the support or resistance level. When the market comes to the level and then break it, we are waiting to see that first, it should break through, rather than just consolidating there. And second, it should break enough. I mean, it should go down further enough to make sure that it is a breakthrough rather than just consolidating. Because sometimes market, due to the momentum, it could just break a little bit and then reverse. And then we can trade for the pullback. Here comes 2 bull bars. These are the pullback. Then after that, there's a very good signal bear bar. We can go short at this opportunity. And we can trade for the second or the third leg down. In terms of the profit target, we can also use the measure move as the profit target, or we can even use the n times your risk based on your study. Instead of using the support and resistance levels as the setup, we can also use for the profit target, like I mentioned in the previous trading range example. However, there are also other ways that you can set up your profit target. They include the trend line, the n times of your risk, the previous leg, or other levels that you can see from your chart. However, you should select one of the most reasonable ones. Second, you might think of taking part of your position off prior the supported resistance levels in case your profit target is beyond the supported resistance levels. That is because when the market reaches the supported resistance, it could really reverse. And also, another thing is that even for the supported resistance, it's possible that the market might not reach it. So if you don't take part of your position off, it's possible that your trade will end up as a losing trade. Now let's move to the last part of this video. So I will show you some trading examples. There are two types. The first one is the boundary reversal, and the second one is the level breakout. So comparing these two types, there are some differences. The first one is that for the boundary reversal, most of the time it will appear in the upper time frame because it's most likely like a trading range. So we can see them more in the 30-minute, 1 hour, or 4-hour charts. However, on the 5-minute or 15-minute charts, we don't see them quite often. Another thing is that the winning probability for this boundary reversal is not as high as the level breakout. That is because the boundary reversal, most of the time, it's in the end of the trading range. However, for the level breakout, normally it leads to a start of a new trend. That's why the level breakout have a higher winning probability. Another thing is that the level breakout usually will lead to both scalping and swinging opportunities. That means you can take more profit if you catch the trade in the start of the trend. Let's first take a look at the boundary reversal example. So the market comes down here and here, makes two lows. So we can draw a level for the support. And then when the market comes to the support level for the third time here, there could be a very good opportunity for you to go long. So what we are waiting for is to touch the level and then bounce back. We can see that this third touch reacts to the support immediately because we can see this big tail of this bear bar. That means this level is robust and then it's very strong. And then it increases the opportunity or probability for the winning trade. And then we wait for the signal bar. That we can use both this bear bar or this bull bar as the signal bar. The reason is because for this bear bar, it is a hammer type. So the tail is very big. It's strong support that we can enter at the top of this bear bar. Or we can wait for another bull bar to be more confident and enter at the top of the bull bar or even the close of the bull bar. In terms of the stop, we need to give it a little bit more room. That is because the initial stop should be a protective stop rather than you put to the bottom of this bear bar as the actual stop. Only when the market goes your way, you can move your protective stop to the actual stop at the bottom of this bear bar. Another thing is that as the market moves on, you can see if there's another pullback here. The reason that there's a pullback is because we can see it's the same situation in the previous touch here. We have the market comes down here to touch the support level, bounce back, and then there's another pullback here, and then it goes up. That's why it comes to the pullback here again. Also, another reason is that we are technical traders. We assume that the chart will repeat itself. That's why when we see this small pullback, we're expecting there's a pullback here as well. And then when you see this small pullback, again, you wait for the very good signal bar. So this bull bar is a very good signal bar. You can enter at the top of this bull bar. That means if you enter the position here, so when you see the pullback, you can add on to your position to take more profit of this support. However, if you didn't take the opportunity at the first touch, and then you can trade here, this is another opportunity for you to enter the market. Otherwise, you're going to miss this good trade. In terms of the profit target, based on the chart here, it's reasonable to set your profit target as the previous minor high here. And also, the reason that you can see this bull bar with a very big tail, it reaches your previous minor high target. However, there's a big tail there because the other traders in the market are using the same profit target to take the profit. That's why there's a pullback here. After you take your profit at this bull bar, and then the market didn't go down further, instead, it comes with another good signal bull bar, which is a trend bar. And also, you can see that the pullbacks are very shallow. This bull bar is so big, that means the uptrend is very, very strong. What you want to do is to re-enter the market, even if you already took your profit at this bull bar. And then, you put your entry at the top of this bull bar, and then you can aim at the profit target of even higher, like this high or even this high. There are two options for the profit target. So basically we can use either the measure move or the previous high or low. So let's take a look at the measure move first. We can see that there is 1, 2, 3, 4, 5 consecutive bull bars for this leg. That means it's a breakout mode. For the breakout mode with a shallow pullback, we can do the measure move for sure. And then we measure from the bottom of the first bull bar until the top of the last bull bar for the first leg. And then we measure again from the bottom of the pullback and then measure the same distance or same height. Then we can see the next bull bar after this signal bar, just this second bull bar here, the profit target is met by the measure move. The second option is we use the previous high. This is the previous high. We can either use the top of the high, or we can use the close of any of the bull bar or bear bar here. So basically you can see that both profit target are met. And also for the top of the bear bar here, for the this major high here, you can see that we have a bear bar with a big tail at the top. This also means other traders in the market are using the same profit target to take the profit. After this second leg up, you can see the market movement here. Basically, this is a stairs pattern. So for stairs pattern, it is high probability setup, and 90% of the time, the trend will continue. So in my channel, I have a video on this stairs pattern that you can watch. And then, if you choose to take this stairs setup and then enter a long position, you can think about a profit target like below. First, in the whole screen here, it is a trading range rather than a trending day. So your profit target should be conservative or realistic. Second, this is the first leg, second leg, and the third leg. For the second leg, it has the highest probability, and the probability will be lower for the third, fourth, or fifth leg. So in terms of all these situations here we considered, we want to take 1 time of the risk to be conservative, to take the profit. And also, we want to measure whether the 1 time of risk will reach the top of this high, because probably the market will test this high. It could reach or it might not reach. So when you see this pattern, you want to do your calculation first before you enter the market. However, you can see that this stairs pattern leads to the continuation of the market to the upside. Now let's move on to the example for the level breakout. So take a look at this chart. First, we have a London Open at this bull bar. And then we also have today's previous low, like this level. If we draw this level, we can clearly see that the market first goes up and then goes down here to test this level. However, we also have other levels we can draw on the chart. The first one is this pivot level, PP, and also the support level 1 and support level 2. And then when the market goes to the London Open level here, we can see that it is crossing the London Open. However, with this bull bar and this bear bar, like I said, we're not sure whether it is breaking through or it is just a reversal. So we wait a little bit and see the price action. Based on the price action in the following bars and also with the previous bars, we can see that the bulls are very weak and the bears are strong. Before this breakout, we can see that we have the consecutive bear bars. Even though the bear bars are not strong, however, they're consecutive. That means the strength of the downtrend. And when we see the bull bar here, it's very small. Bull bar very small. This is big, however, there's no consecutive bull bars. Here are consecutive bull bars, however, this bear bar and this bear bar reverse all the 4 bull bars. This is before the breakout. After the breakout, we can see that this bull bar is small, with 2 bear bars following, and then 3 bull bars. However, these 3 bull bars are small, and then only 1 bear bar can reverse all the 3 bull bars. All this means the bulls are very weak and the bears are strong. So we can determine that this is a downtrend. What we want to do is to wait for the pullback and then trade the pullback. Basically, there's another level, support 1. We have to observe the market price action when it goes around this support level. We don't want to enter the market so quick, because when it touches the support 1, it could really bounce back to the upside. However, the market ignores this support level 1 and then goes down and penetrates it. So at this moment, when we see these 3 consecutive bear bars penetrating this S1 level, we're sure that right now it's a downtrend. And then when the pullback comes, we want to trade for the pullback. Here comes the pullback. We can see these 2 bull bars here, reaching S1. However, it didn't penetrate S1. Instead, its tail is at the top of S1 and the body is at the bottom of S1. And also the next bar is a very good signal bear bar, because the body accounts for 60% of its candlestick. And then we want to put our short order at the bottom of this bear bar to go short and take the downtrend. After taking the short position at this bear bar, we continue observing the market. What we can see is that here there are 1, 2, 3, 4 consecutive bear bars. That means the downtrend is very strong. And then we can see that there's a bull bar as the pullback, because the next bar is a bear bar again. So this small bull bar can act as the shallow pullback. So for the shallow pullback, then, and also with the strong market downtrend here, we can enter the market again to add up the position. So basically, we want to enter when we see this bear bar, even though this bear bar has a very big tail at the bottom. But it doesn't matter. In the strong trend or in a very strong setup, the signal bar doesn't matter. We can enter the market. And then in terms of the profit target, there are a few options. The first one is n times your actual risk, which is based on your study of the historical chart or your backtesting. Second is the measured move. We can do the measured move like the previous example. This time we measure from the top of this first bear bar here, and then measure down to the bottom of the last bear bar. This is the distance. And then we measure again from the top of the pullback and measure down the same distance. Then you can see that this measure move is also met here. The third option for sure is the S level 2 here. So we have 3 options, and then you want to take the one that is suitable for your strategy. And in the end, you can see that even for the S2 here, it's already reached. That means the market respects the support level here, S1 and also S2. Like I mentioned before, for the level breakout, normally there's good opportunities for both scalping and the swing. So if you take the position at this bear bar here, you can swing your position, at least partly of your position, to the end of the trend, or even before it reaches S2. So basically, if you want to scalp to take a quick profit, what you can do is that you use these 3 bear bars as the measure move and measure down here, or you use the n times of your risk. And then for the rest of the position, you have to keep your stop at the top of this pullback. Otherwise, when the market comes back and you put your stop back to the break-even point, you could really get stop out. So for swing, you have to give the market some breathing room. And then you need to read the price action as the trend develops. So when it comes here, you can see that the pullback is very shallow. Then you means you want to keep holding your position until the end of the trend. And then the profit target here is very reasonable. You don't want to move any further at this point because the market already went down so long. And then after that, you can see the pullback is huge right now comparing to this pullback. The previous chart is a 5-minute chart. Now let's have a look at the same but 15-minute chart. So basically, you can see that we have the same level here when the market breaks down here with 4 consecutive bear bars, which means a very strong market. And then it goes down even to penetrate S1 right away. And then there's a pullback with the bull bar. At this time, if you enter the market, you want to enter at the bottom of this bull bar. Basically, for the upper time frame, we don't care that much about the bear bar or bull bar as the signal bar, because the higher time frame, that means each bar is very large. We don't want to wait for another very good signal bear bar. Like this, when you enter here, it's already too late for you to enter the market. And then we can do the same thing like the measure move. Let's have a look on what's going on with the measure move if we trade the 15-minute chart. So basically, this is the first leg with 4 consecutive bear bars. We measure from the top of the first bear bar until the bottom of the last bear bar. And then we do the same thing, measure from the top of the pullback until the same distance. We can see that this small bear bar comparing to the bar before it and after it is just small. And then it pulls back here and then reach the target. Another angle to see this is why the markets just pull back here at this level. The same thing, other traders on the 15-minute chart take profit at this moment. That means you're competing with the traders from different time frames, and then you need to find out which time frame is best for you. Even though later on the market really goes down to test the S2 level here. If you enjoyed my video, please don't forget to subscribe, like, and comment. You can also go to my channel for more videos. Thank you. In day trading, there are a lot of reversal patterns, and the V reversal is one of them. V reversal normally leads to the second or third leg, so it provides good opportunities for both scalping and swing. So in this video, I'm going to show you how to identify the V reversal and trade them. Let's get started. I'm going to cover the following topics. Number 1, V reversal basics. I'm going to show you the characteristic of a V reversal. Number 2, the V reversal in day trading. I'm going to show you the setup, entry stop, and the profit target. Number 3, I'm going to use some examples to show you how to trade V reversals in day trading. What is V reversal? Basically, at a glance, you can see that it is a V shape or flipped V shape. The basic thing about V reversal is, at the top or the bottom, it is V shape, it's sharp. There are a few characteristics for this V reversal. The first is the reversal should be sharp, which means the market should bounce back very quickly. And the second, for the bounce back, it's better to be the breakout pattern, which means they are consecutive either bull bars or bear bars. Also, it is better that the V reversal accounts for your whole screen, which means if you're doing day trading, the reversal is for the whole day pattern. Last, there are more V than flipped V, which means normally we'll see a more like the downtrend in the beginning and then it reverses back with the uptrend rather than the opposite way. Now let's move on to the V reversal setup. Let's use V rather than the flip V for example, even though they are sharing the same logic. First, we want to see a downtrend. We can see that here's a downtrend, and then the market reverses immediately because there's a doji bull bar with a tail at the bottom. And then we want to see breakout mode, like the consecutive bull bars here, that we can see there's, including this doji bar, there's 1, 2, 3, 4, 5, 6, 7 consecutive bull bars. And then we want to see the bull bar breakout take out the previous major or minor high. So here is the major high. That is because we have a high here, we have a low, we have a lower high, and then we have a lower low. That's why this is the major high. It's taking out this major high. So this is the setup for the V reversal. Now let's move on to the V reversal entries. Basically, we want to wait for the pullback and trade the pullback. So in this example, here comes one single bear bar. This bear bar can serve as the pullback. And then we want to wait for a very good signal bull bar. So here comes a very good signal bar because the body of this bull bar accounts for over 60% of the whole candlestick. You can also choose other candlestick like this bear bar, but the probability for the timing of the uptrend will be lower. And then there could be 3 pushes before the trend actually goes up. That means after this bear bar, you can expect another bear bar or a third bear bar before it goes up. And then even in this chart, you can treat this as the first push, this is the second push, and here is the third push, and then with a very good signal bar. Really depends how you interpret this chart. And last one is, it's better that you wait for the signal bar to finish before you enter, because in the development of the bar could really end up with a bear bar or bull bar. You never know. It's better to wait for the bar to finish. In terms of the V reversal stop, there are a few options. The first one is, if you assume this is the pullback bottom, you can place the stop at the bottom of the pullback here. However, the thing is, the market might not go up right away, so it could really get you stop out here. Second, you can put in the halfway of the bull breakout here. Basically, if the market reverses back half or 50% of this whole breakout, it might not be a very strong market. So it's possible that the uptrend will end, or it is not a real V reversal. Because even for V reversal, there's a probability of winning ratios. And the 3, you can put at the bottom of the whole V reversal here. That you will give more room. However, if you get stop out, you're going to lose a lot. So in terms of which one to choose, you should really study the chart of your financial instruments you're trading on, and then make a decision by yourself. For the profit target, there are also a few options. The first one is N times your actual risk. Previously, I mentioned the stop. Those are the protective stop. Your actual stop should be at the bottom of the real pullback whenever the trend goes up. And then in terms of this N, it's really based on your study. So for the scalping, normally it is between 1 and 2. The second option is use the previous high. This previous high can be the previous day's high or the previous high in today's chart. For example, here, this high is the previous high in the same day. We can use this as a profit target. Number 3, we can also use the pivot level. So for example, here we have the R1, so we can use this as the profit target as well. Number 4, we can use measure move. Basically, for measured move, we want to measure from the bottom of the first bull bar, which is this doji bar, and then measure at the top of the last bull bar for the first leg. And then we measure the same thing from the bottom of the pullback, and then the same distance. And here should be the profit target. You should select the one that is the most reasonable and practical, and also based on your trading strategy. In terms of how to use the levels as the profit target, I have another video in my channel that you can watch for more information. Now let's move on to the last part of the video. Let me use some trading examples to show you how to trade the V reversals. Let's take this chart for example. First, we want to have the levels drawn on the chart. Here is the previous high. It could be previous high in the same day, or it could be the previous day's high. And then we also have some pivot levels. This is the PP level. Then the market goes down, and then there's a V sharp here. Then we observe there are 4 consecutive bull bars breaking out the previous major high. That means we're waiting for the pullback since this is a V reversal setup. And then here comes the pullback. We have 3 consecutive bear bars here. And then we're waiting for a signal bar. The next bull bar could be served as a signal bar. However, it is not a very good signal bar because the body accounts less than 60% of the whole candlestick. You can also see the market didn't go beyond this bull bar. And next, we have another bull bar after another bear bar. So this bull bar is a very good signal bar because the body accounts for more than 60% of the whole candlestick. Then we put our entry order or buy order at the top of this bull bar, and you can see the market just takes off. Another thing you should notice is that we have the level PP here. This level here, we can see it serves as the support level. And then the market goes back here and then go back here, touches it, and then this level serves as the resistance. And then the market penetrates it again and then pulls back. It serves as the support again. So this PP level is a very strong support or resistance level. So whenever you see something like this, there is a high probability that the trade will be a good winning trade. For the stop, we can put at the bottom of the V reversal here. We can also put halfway. However, because this pullback is too much, we can select the stop to be the bottom of this big bull bar here. And also you can put a little bit further below this pullback to give it a little bit more breathing room before the trend continues upward. Right after the market takes off to the upward, you want to put your stop right below the pullback. So basically this is your actual stop. And then your entry is the top of this bull bar. So your actual risk should be from the bottom of the pullback to your entry level here. So this is your actual risk. Let's have a look at the profit target. If we use the 1 time of your risk, we can see that the profit target is here. If we use 2 times your risk, you can see that the target is here. In this case, you can see that the market didn't reach the 2 times of your risk. However, if you scalp for 1 time of your risk, you're gonna get a profit. Let's also do a measure move. So we measure from the bottom of the first bull bar rather than this bear bar. And then we measure until the top of the last bull bar rather than this top of this bear bar. So this is the first leg. You want to do the measure. And then we measure from the bottom of the pullback and the same distance here. This is the measure move profit target. You can see that the market reaches the profit target for the measure move and then pulls back, which means the other traders are using the same measure move technique to take their profit. That means if you don't take your profit and you're waiting for the market to go even further, so your profit target might not be reached. So you should be very careful about the profit target. You can also use other levels you identify on the same chart. For example, here we have 2 highs. This one is a previous major high here. This is the previous high in the same day. Both of them can serve as the profit target. However, you can see that only this previous high is met here. And then the previous high for the same day, the market never touches it. So that means if you put your profit target as the previous high here, then you won't take the profit. And then the market can just reverse, and then if you don't manage your trade well, you could end up with a losing trade. Let me also show you how to use other information on the same chart to help you to do the trading for V reversal. So let's take a look at this chart. First, we have a previous low here, and we also draw the pivot level here. So this is a V shape here, the previous major high, and breaks the previous major high, we enter at the pullback. And you can see that here this PP level serves as the profit target. It's met. However, the trend goes even further. Why it goes even further? We could have some clues here. The first thing is we have the previous low drawn here. This level, the market comes down to test this level but failed. That means this is a very good support level. We're expecting the market will reverse. This will increase the probability. And the second thing is, if you notice here, before the V reversal, we have a trading range here. The trading range doesn't go anywhere, and then there is a lot of overlap of the candlestick bars between each other. And then this also increase the probability that when the market moves, it could move even further. So that's why this part beyond the PP level, it is explained by this support level as the previous low and also as the trading range here. Here's another example. You can see here, it doesn't seem to be a V reversal setup because you can see there are multiple bars, 3 bars here. However, this is a 5-minute chart. If you go up to some higher time frame, this is the 15-minute chart, you can clearly see that this is a V reversal. So basically, when you do the day trading, sometimes you have to switch between different time frames for you to do the day trading. Let me show you another example of using multiple time frame. This is the 5-minute chart. However, you can see it is very choppy here and here. There are a lot of overlaps between the bars next to each other. It is hard to decide sometimes. Then you can go up to the 15-minute chart, and in this chart you can clearly see that this part is clear and this part is also clear. So in the 15-minute chart, you can see there are multiple signal bars that you can use. So rather than a lot of noises from the 5-minute chart. Here's another example of the V reversal. However, what is special about this chart is that you can see the trend, the downtrend is not very straight down. So we have a pullback here and then goes up and down. However, later on, you can see that the market takes out this previous major high and then we can enter here. So this is not a very perfect V setup, which means the probability of uptrend will be decreased. So the market could really go up to test this high and then reverse back. Let's take a look at this example. Clearly we can see this is a V reversal here. However, this V reversal doesn't go up even further. That is because this V reversal does not count the whole screen. Like I previously mentioned, it is better to trace the V reversal, which is the whole pattern for the whole day. However, in this chart, this daily chart, we can see that this is definitely a trading range. And then this V reversal is only part of the whole trend. That is why the probability of the winning trade is very low. Now let's have a look at the flipped V reversal example. Take a look at this chart. We have an uptrend here, and then we have a V-shaped reversal because we have consecutive bear bars here. And these bear bars will take down the previous low here, and then it moves downward. This bull doji bar can serve as the pullback, or these two bull bars can serve as the pullback. Then we enter here. So the trend continues downward. For this chart, we can see it is a V reversal. This is the previous minor high here, and then we enter at the pullback. Even though there's no bear bar here, however, this bull bar with a big tail at the top is the pullback. We can enter here. However, you can see the market doesn't go very far, and then it goes back to a trading range. That is because you can see the pattern here is there are consecutive bear bars here. So this downtrend is very, very strong. That is why the V reversal here going back up, that is not strong. So this is something that you want to observe while the market is developing and make a decision whether the reversal is strong or not to set your profit target. Let's take a look at this example. We have the V reversal here, and then we enter at the pullback. However, the market only goes down here, and then it didn't go down further. That is because if you take a look at the previous high here, this is the London Open, and this serves as the support or resistance level. So this is a very good example if you are trading the currencies, especially you are trading GBP or Euro. So London Open could be a very good level or target for you to take. In this example, this is a V reversal. And then we have consecutive 1, 2, 3, 4, 5, 6, 7, 8 bull bars, which means a very strong uptrend. However, when we have the pullback here, it becomes very choppy. That is because we have the first push, second push, and third push, and especially the second push, it wants to go down further. That means there's a pressure from the seller. So that's why when you see the trend continues up, it doesn't go any further other than here, and then it pulls back again with a very choppy pullback. So when you see this kind of a pullback, choppy pullback, you're not expecting the uptrend will go even further, even though we have a very good start of the consecutive bull bars here. Let's take another example in reading the pullback. So here's the reversal. However, we can see the pullback here is horizontal and it didn't go further back up. So when the market moves again here with 4 consecutive bear bars, that means the market starts moving even further. What you can do is that you can trade when the pullback comes. So you can see this bear bar can serve as the signal bar, and then the market goes down even further. So comparing this chart and the previous chart, you can see the pullback can really tells us the market movement. The previous example, the market pulls back too much. However, in this example, it pulls back horizontally. That means this trend is stronger than the previous trend. Let's take a look at this chart for the pullback. So basically, we have the V reversal and the market goes down to break the previous low. We are waiting for the pullback. However, you only see a very small doji-like bull bar here. So basically, this bull bar is the pullback, even though it is a very small pullback. So you want to trade when you see this signal bar, the next bar. So when you read the market, you want to identify what is the true pullback and then trade accordingly. Sometimes the pullback could be further, sometimes the pullback could be shallow. If this is a shallow pullback, that means the downtrend is very strong, so you should be very confident that the market could go down even further, or even you want to swing your trade. If you enjoyed my video, please don't forget to subscribe, like, and comment. You can also go to my channel for more videos. Thank you. Double top and double bottom are very traditional pattern in day trading. Sometimes they will lead to good trading opportunities, though not all the time. So in this video, I'm going to show you how to identify the double top and double bottom opportunities and trade accordingly. So let's get started. I will cover the following topics. Number 1, double top and double bottom basics. Here I will use M and W to replace double top and double bottom. Number 2, how to use double top and double bottom in day trading. Basically, there are 2 setups. The first one is the reversal setup, and the second one is continuation setup. And in the end, I'm going to show you some trading examples. What is double top and double bottom? Basically, in the first look, you should be able to identify it is either M or W. Here, you should be able to see clearly there are 2 pushes up in the M and 2 pushes down in W. There are a few things about the double top and double bottom. Basically, as we know, double top and double bottom are reversal patterns. Here, the reversal means the reversal of the first leg. Let's take this W for example. So for M, it's the same logic. We have the first leg down here, and then it's a downtrend. And then the last leg is reversing the first leg. So here it's only reversing the first leg. It depends on where this W is. It could be reversing of the whole trend, or it could be the continuation of the whole trend. However, the reversal here refers only the first leg. Second, for the second push down here, whether it is making a lower low or a higher low, it really doesn't matter that much as long as the 2 pushes are relatively on the same level. So even though the higher low will have a higher probability of the reversing of the trend. The third thing is about the probability. So basically in the old days, this reversal pattern had a very high probability of winning trades, especially for the long-term trending. So a lot of traders made a lot of money by just trading the reversal pattern because this pattern normally leads to very big trend. However, these days, due to the increased trading volume, especially with the computer programs, the probability is lower over time. It is the same situation for the candlestick patterns. In the old days, you don't have to pay much attention about the whole setup and the whole chart. You can only trade the candlestick pattern and have a very good winning ratio. However, these days, the candlestick patterns don't work very well. Now let's move on to the second part of the video. So it is about the double top and double bottom in day trading. There are two setups. The first one is the reversal setup. So basically, the reversal should be the pattern for the whole day. That means if you take a look at your whole screen for the whole day, you should be able to identify it is a double top or double bottom pattern. Second, it's the continuation setup. So basically here, it doesn't really matter whether it is a trending day or range day or reversal day. This double top and double bottom is only part of the pattern for the day, which means it serves as the pullback for the whole trend. Now let's take a look at this chart for the reversal pattern. First, we have a downtrend here. And then we have a low, high, and a low. And then what we are waiting is for the market to break the previous high. Here's the previous high. And then the market breaks a little bit. Then we move on to the next step. This step is very, very important, that we need to observe the price action after the break. That is because previously we have a downtrend here. We have a high, and then it breaks a little bit. However, it is still in the short buyers. So a lot of traders are still selling here. So if the market continues here to the downward, that means this is the double top for the continuation pattern. That is why this step is very important. And also you can see that here we have a bear bar. So a lot of traders will put their sell order below this bear bar. And this is another bear bar. You can see that the market actually goes down below this bear bar. That is because there are sellers who's gonna short also to the downtrend. And then what we can see is that the price action shows us there's a pullback of the bear bar, and then it reversed by two bull bars here, and then another bear bar by two bull bars, another bear bar. So that means the bear is losing its steam, and then the bulls are getting their strength. And another thing is, just based on this part, you can see that the market is making higher highs. This is high, this is higher high, and another higher high. Also, at the same time, it is making lower low, higher lows. So this is the low, this is a higher low, and this is another higher low. This is also a confirmation of the uptrend or buying pressure. Another thing you should notice is here, this bull bar. Basically, this bull bar is a little bit higher than this previous high. This is another way for you to confirm it is an uptrend. So there also could be other indicators that you can use for the confirmation to the upward. For example, if you have a EMA drawing on the chart here, you should be able to see that around this area, most of the time, the bars are above the EMA. So that is another confirmation for the uptrend. If that's the case, you're having upward buyers right now, then you need to wait for a very good signal bar to trade upward. So here comes a very good bull bar, because this bull bar has 60% of the body account for the whole candlestick. So you should enter upon the finish of this bull bar, either at the top or upon the close. If the 5-minute chart is too choppy and not clear to you, so you can move upward to the higher time frame. So here's the 10-minute chart. We can see the price action around this area. So here, the pullback, here is a bear bar here. However, the tail at the bottom is very big. That means the support. The next one is also a bear bar with a very big tail at the top. However, the body is very, very small. And then even the close is still within the previous bull bar here. So these two bear bars didn't reverse much. That means the buying pressure. And then the next bar here, it breaks the previous bear bar top. That's the strength. So upon finish of this good bull bar, which accounts 60% of the whole candlestick of the body, then you need to enter the market. For the candlesticks, I have another video in my channel that you can watch. So in that video, you will learn how to use the candlesticks to tell the strength of the market and how to use the candlesticks for the signal bars. Right after you enter the market, you should put your protective stop there. So there are a few options. The first option is you put your stop at the bottom of the pullback. So basically here is your pullback bottom, so you put at the bottom here. The drawback for this is that the market could really go down again to test the pullback, and then it's possible that you get a stop. The second option is you put at the bottom of the whole pattern. So here, this one is the lower low based on these two pushes. So you put at the bottom of this pullback. The good thing is that you give a very good breathing room for the market to develop. However, if the market really comes down here, you're gonna have a very large stop. However, most of the time, before the market goes down, a lot of traders will already close their position, because while the market is going down, that means this W shape doesn't work anymore. It's not valid, so you're out of the market. The third option is you can put in between this pullback bottom and the bottom of the pattern in between. So one option is you use the bottom of a trend bar. So this bull bar is very big, and then it serves as a trend bar. So you can put at the bottom of this trend bar. Then you give enough room for the market to develop, and then at the same time, the risk is not that much comparing to the bottom of the pattern. And then right after the market takes off, you can see that the market goes your way to the upward. Then you need to move your stop, protective stop, to your actual stop, which should be the bottom of the pullback. For the profit target, there are also a few options. The first option is N times your actual risk. So basically here is your actual stop. You measure your risk from the actual stop until the entry. So if you enter at the top of this bull bar, so here's your risk. This is 1 time of your risk. And then if you measure up, you can see that this is the 1 time of your risk if you take the profit target here, and then this is the 2 times your risk. You can see that in this example, it reaches the 2 times of your risk. However, you can also use a fixed amount of profit. For example, if you are trading the currencies, you can take 10 pips. Or if you're trading crude oil, you can take 10 cents or 20 cents. If you're trading E-mini S&P 500, that's 2 points or 3 points. Or ETH, you can take $200 or $300. It really depends on whether you can have a constant profit based on your calculation of the historical chart. The second option is to use the previous major or minor high or lows. So take this for example. Here we have a level here. This is the previous high here. The reason is because here you can see the market goes down here. So this level serves as the support. And then after it goes down below this level, it serves as the resistance again. So this level is very important support and resistance levels. So it is reasonable for you to use as a profit target. Another level is here. You can see that here is a minor high here, and then here's a low here. That means this is the support, and here serves as the resistance. The third option here is the top here. This is the previous high for the same day. It is also very reasonable for you to have your profit target here. However, in the end, you should select the one that is most reasonable to you and which is the easy to reach for you to take the profit. The third option is the measured move. So basically, most of the time the market moves by waves or at the Elliott waves. So there might be 1, 2, 3 legs here, and then each leg most of the time will move roughly the same distance. So if that's the case, we can do the measured move for the first leg from the bottom of the start of the first leg until the last bull bar here at the top. So this is the measured move. And then we measure the same distance from the pullback for each pullback basically. So here's the first pullback, and then we measure up by the same distance. So here's the profit target. And then there's another pullback. We can do the same measure again. So from the bottom of the pullback and then measure up. So you can see that if we use the measure move for this second leg and the third leg, they meet the profit target. As we can see that there are multiple legs in the trend here. So if you want to take more profit, you can choose to swing rather than scalp, or use scalp and swing at the same time. However, one thing for beginner to notice is that for the swing, you really need to survive this pullback. For this example, your entry is at the top of this bar. However, you can see the pullback comes down too far. It's almost there for your entry level. So it's very hard for beginners to hold for that long, especially for so many bars here. And a very good option for you is to take part of your position off along the trend. Here's an example. In case you have enough position, what you can do is that, so you can take half of your position off by 1 time of your risk. This is because when you take half off, even if for the rest of the half, the market comes down to hit your stop at the bottom of the pullback, you're gonna break even. So you're not losing anything. This is very important for the beginner traders. And then you can take another 1/4 of your position at 2 times of your risk. Basically, from the previous calculation, 2 times of your risk is at the top of this tail of this bull bar. And then you can choose to swing the rest of your 1/4 of your position to the end of the trend. So if you take your profit for this 3/4 of your position, you don't feel any pressure to swing the rest of the position. And then you can see that the market goes for the third leg, you can take more profit. Now let's move on to the continuation pattern. So for the continuation pattern, it normally happens at the start of the trend. It's different from the reversal pattern, which happens at the end of the trend. So for this example, we have a consolidation and then the market breaks downward. We have the pullback here and then another push here. So these two pushes forms the double top. And then this whole double top serves as the pullback. Then we want to do is to wait for the signal bar to enter. So here is the bear bar here. We can enter here, though this signal bar is not very strong. Or we can choose for another signal bear bar here, 2 bars we can enter at the bottom of here. Or even we can enter at the low of this pullback here. So no matter which way, it also works. One thing to notice for this continuation pattern is that basically here there's a downtrend. And then here's the first pullback. A lot of traders will already enter the market in this first pullback. So you don't have to wait for the second pullback because you never know whether there's a second pullback. And then this second pullback can serve as a good opportunity in case you didn't enter the market here because this bar is not very strong. And then when the market goes down, you miss the opportunity. So when it pullbacks again, so you can re-enter the market. Or if you enter the market for the first time, and then you can add to your position at a second pullback here. So whichever way that works. Another thing to notice is that the second pullback is higher than the first pullback. So in case you choose to enter the market at the first pullback, and then you put your stop at the top of this pullback here, you're gonna get stop out. That is why that it's better that you give a little bit more room for the market to breathe. Let's say you put the stop at the top of this bear bar, so you won't get stopped by this pullback. We can see the double top or double bottom can serve as the pullback for the continuation of the trend. However, the 3 pushes can also lead to reversal or continuation trend. So the same chart here, we can see that after the market goes down, we have the first push up, second push up, and third push up, and then the trend continues. Again here, so this first push up, second push up, and then third push up, and then market continues. So this is something that on top of the double top and double bottom, 3 pushes can also serve as the continuation or reversal pattern. I will have another video to talk about this later. The same situation for the protective stop. So there are a few options here. The first one is to put at the top of the pullback here. That means it is very tight. You could get stop out if the market goes back to test this level. The second is at the top of the pattern here. You give more room, but more risk. And then third is to in the middle that you can put at the top of a big trend bar here. This makes more sense. For the profit targets, it's the same thing. So the first option is end time of your risk. If we enter at the bottom of this low here, then we measure from the top of the pullback. Here is your actual risk. If we measure down, we can see that this is the 1 time of your risk, and this is the 2 time of your risk. We can see that the market bounced back here because some traders will take profit at here, And then here you can see it bounce back again. That means some other traders will take 2 times the risk. If we enter at the bottom of this bear bar, we can see that this is 1 time risk, and then your profit target is here and also here. That you can see the market bounce back here. That means other traders taking the profit at the same time. We can also use measure move. So the same thing, we measure from the top of the first bear bar here until the bottom of the last bear bar for the first leg, and then we measure down from the pullback. So here's your profit target for the second leg. And then if we assume that this is another pullback for the third leg, we can measure again here. So you can see that the market just go down to touch the measure move. That means other traders are using the same measure move to take the profit. And also you can use the high lows from the previous day or from the same day previous chart, or you can use other support or resistance levels. It works the same. Now let's move on to the last part of the video. Let me show you some examples. Let's take this chart for example. First, we want to do some preparation for the trading. We want to draw all the important levels. This level is the previous day's high. And then we also have a high of the same day. Then we can have some pivot levels, such as the R1 and the PP. Then we see the market goes down here and then makes a high here. And then it goes down and pulls back. So when we see this bull bar, it is breaking the previous high. So it is possible it is a double bottom, reversal of the previous downtrend. And then for this bull bar, we can see that it is a very good bull trend bar. It is the largest bar in the chart because it is larger than all the bars on the left. So basically for this bull trend bar, that means a high probability of the uptrend. So you can also see the same thing in my candlestick videos. And then what you can do is that you can choose to enter at the top of this bull trend bar to capture the trend early as possible. However, you can also wait for the pullback. The market moves up by another good bull bar, and this bull bar breaks the previous high here. This increases the probability of uptrend, and then right now you want to only trade upward. What you want to do is to wait for a pullback. So basically here comes another doji bear bar. So this doji bear bar can serve as the pullback, especially for the very good breakout pattern here. And then you want to enter at the top of this doji bull bar. That is because of the strong uptrend here. Or you can wait for another good signal bar for the next bull bar here. It is a very good signal bar, and then you can enter at the top of this bull bar. However, the market didn't go right away beyond the top of this bull bar. Then you can choose to wait for another good signal bar. When the market comes down for another 2 bear bar here, you can see that these 2 bear bar didn't reverse even the previous bull bar. So that means the pressure for the downward is not very strong. And then when you see this small bull bar, even though it is small, it can still serve as a very good signal bar. So basically, for the very strong trend, the signal bar doesn't matter that much. The requirement for them is not very much. And then you can choose to enter at the top of this good signal bull bar. If you didn't enter at this pullback and this signal bar, you can see there's another very good bull bar here. However, the thing about this bull bar is that it is too close to the previous high and the previous day's high. So if you choose to enter here, it's possible that the market will pull back right away. So you can see the market respect this high a little bit and also respect this previous day's high. So that means your profit target might not be reached right away. Right after the market goes to your way, you need to put your stop at the bottom of this pullback here and then hold very tight, because later on you can see the market comes down to test your stop, but it failed. It didn't reach your stop. So this is very important for you to understand that if the market really goes down to stop you out, you really need to take the loss. In terms of the profit target, let's take a look at this reversal pattern. We have a downtrend here. However, the upward reversal is very strong with two good signal bull bar here. That means the trend will go up very far. So that means you can see that for each of the level, for the R1, the previous high, they also reached. And even for the measure move here, it also reached. So if you see that this very strong reversal trend, you want to put your profit target as far as possible to take more profit. Now let's take a look at a continuation pattern. So the same thing, first we want to do some preparation. Here's the previous day's low. And then we also have a low of the same day. And then we have a trend line here. So basically, when you see the trend line break here, you can wait for the pullback, which is this bull bar. And then this is the signal bar. You can trade down here already. However, you can also wait for the market to go down to break the previous low here, this level, and then wait for the pullback. So if that's the case, you're going to enter the market upon seeing this bear bar. However, the market goes back here to be beyond this pullback. And then it has this bear bar. You can also enter at the bottom of this bear bar because right now it seems that there's a double top here. And then you can see the market goes down. However, it goes back up. So it makes another higher high. So basically this high and also this high can also serve as the double top. So you can enter the market when you see the pullback and then goes down. Basically, after you enter the market in this bear bar, you want to put your stop at the previous pullback here. This is a very reasonable one. So you won't be getting out of the market. Also, you can put your stop at the top of the trend line because if you are trading the trend line break, this is also reasonable stop level. And then you can see the market moves back downward again. And then you can use this bear bar or even this bear bar to enter the market. And also you can use this low here to enter the market as well. So in case you enter at the bottom of this bull bar here, that means you want to measure the profit target by the actual risk based on this. So you can see that this is the 2 times of your risk here. It is lower than the previous day's low. However, the market goes down to the previous low and then it pulls back. So that means the previous day's low is a very reasonable level for you to take the profit rather than the 2 times of your risk. Because when the market pulls back, it goes back up too far that it's going to test your entry level here. So it's very hard to hold your position until this moment. That also means that even the previous day's low, it's possible that the market doesn't reach it before it pulls back. So it's best to take the profit before it reaches the previous day's low. Let's take a look at the whole chart. So basically you can tell the market is not very strong. That is because first, this is the first leg here. And then in between, there's a pullback with a bull bar. So for consecutive bear bars, that means strong market. But if there's a pullback with a bull bar, that means the market is not strong. And also another thing for you to tell is that the pullback here is a double top. Double top normally means the market is not strong if it is a continuation pattern. And then it leads to the second leg down here. You can see that in between there also pullback with the bull bar and bull bar here. That also indicates the market is not strong. And then the market goes up again here. We can see there's another 2 top here. This is also a double top. However, the good thing for this double top is that the second top here is a lower high. That means it increases the probability of the market going down again. And then in the end, it goes down for the third leg. However, the thing is that this previous low is a very strong support. So for the third leg down, the probability won't be that high. So you should be cautious when you take the third leg down with the double top here. Reading the price action is very important as the market develops. In this example, we can see that here's a very strong downtrend because we have consecutive bear bars here. And then we have a double bottom here. However, the market is breaking the previous high here. And then we observe the market. So here we have an area here. We are having the higher highs here and also higher lows here. So at this moment, it's the same situation for the previous example that at this moment, we are sure that the market is going to reverse. In this example, you can see that double top is the pattern for the day. However, there's so many bars between the two tops. If there's so many bars, that means the probability of the reversal will be lower, even though for this chart it goes down. We can also use the upper time frame here. It's the same that we used 15-minute chart here. It's clearer. However, you should be very cautious when you trade the double top here. In this example, you can see that we have a double bottom here. And then the thing is that this double bottom here is very choppy. It's not that clear. But it really doesn't matter. What we want to see is this top. And then it's breaking this top with very strong consecutive bull bars. That means there's a high probability that the reversal will go very high. So you can see that it's beyond the previous high here. In this example, we can see this is a double top. However, this reversal lag is choppy. So that means the reversal is very weak. That you can see that this market doesn't go much further for the reversal lag. In this example, we can see there's a double bottom here. However, this double bottom is part of the whole screen. It is not at the end of a trend, and it is not in the middle of a start of a trend. So that's why this double bottom here failed to going up even further. So you can see that the whole day is a trading range. In this example, we can see there is a double bottom here. However, one thing about this chart is that the previous downtrend has been going on for 6 hours. That's why when you trade the reversal pattern here, you're not expecting the market will go up much further. A lot of times when we see the double top and double bottom, we want to wait for other indicators to confirm the trend. Take a look at this example. So we have a double bottom here at a smaller scale. However, we have a trend line at the bottom here. These two bottom are on the same trend line. That increases the probability of this lag going up. And also here is another trend line at the top. So it's a breaking of the top trend line. So that's why the market goes up. Here's another example. We have the bottom trend line here, and then after we see this top, we can draw a trend line, and then the market goes up again to test this trend line again. So here forms another double top. So for this double top, you can choose to trade downward, and then the market can go down to test the bottom trend line. In this example, when the market goes down here, you can see that it's making a double bottom here. So you can trade the second higher low here. That is because we can see that here there is a level. It is a zone here, serves as the support and resistance, because previously here serves as the resistance, and then when it breaks upward, it serves as the support. When it touches the support for the second time, however, it failed. That means a strong buying pressure here. That's why you can enter at the top of this bull bar. In this example, you can see that we have a double bottom here. So another thing you should notice is that the double bottom is testing the previous day's low here. So this will increase the probability of the reversal. So you can trade confidently. In this example, you can see that we have a double bottom here. And then the market moves up. However, one thing for confirmation is that it is an event day. That means this bear bar with a very big tail at the bottom, that is because of an event. So most of the time, the event can serve as a confirmation if we don't have other indicators like the levels or the EMA. If you enjoyed my video, please don't forget to subscribe, like, and comment. You can also go to my channel for more videos. Thank you. Head and shoulders is a very typical and traditional pattern for reversal trading. However, these days, it has been evolving. So in this video, I'm going to show you how to trade head and shoulders these days, and I will show you some examples. Let's get started. I'm going to cover the following topics. Number 1, head and shoulders basics. I'm going to show you how to define the head and shoulders. Number 2, head and shoulders in the day trading. Basically, there are two setups. The first one is the reversal setup, and the second one is continuation setup. However, not each of them is tradable. Number 3, I will show you some day trading examples on head and shoulders. What is head and shoulders? Basically, at the first look, you should be able to see something like this on the left and the right. So here, you should see one head and two shoulders. Basically, the head and shoulders is a unique type of the three pushes. Here are the examples of the three pushes patterns. So you can see that the three pushes here are almost at the same level, or one is higher than the other. It really doesn't matter. However, for the head and shoulders, you can clearly see one head at the top and then two shoulders below it. So they work the same. And for the three pushes, I will have another video to talk about it. There are a few things you should notice about this head and shoulders reversal pattern. First, the probability of the reversal right now is low. In the old days, the probability is very high because there's not many trading volume, and especially for the long-term trending, the probability was very high. Second, due to the computer programs in the trading, the volume increased greatly, so these days the probability is very low. This is the similar situation for double top and double bottom. So I have two videos for the reversal. One is the V reversal, the second is double top and double bottom. So you can go to my channel and find them to watch. Second, a lot of times that you will see better breakout setups rather than the head and shoulder setup. For example, you can see the trendline break or support or resistance level break, which may give you better option for trading because sometimes you can enter the trade earlier, so you capture the trend earlier. Third, the perfect setup for head and shoulders is very rare these days. When you see the setup is for the whole screen, that has a higher probability. If the setup is only part of the screen, the probability is low and the trend might not be strong for you to trade. And also, for the head and shoulders, it is better to scalp rather than swing because you enter the trade too late in the trend. Now let's move to the second part of the video, head and shoulders in day trading. Basically, there are two types of setup. The first one is the reversal setup. It is better the pattern is for the whole day. The second is the continuation setup. You can see a lot of head and shoulders along the trend, but not all of them are tradable. Let's use this chart for example to see how to trade head and shoulders. As the market develops, you want to wait and see the head and shoulders to appear. Basically, you can see there's one head, this is the left shoulder, and then you're waiting for the pullback for the second shoulder. Here it comes. And then you want to draw the neckline. Most of the time, the head and shoulders are not perfect. So the neckline, there are a few options. The first option for this example, you can see here is a low, and then the push here for the second shoulder here is higher. So you can draw a line, it's like a trend line. Or you can use a horizontal line, but for the lower shoulders here. Both lines work the same, so you can choose either one. And then what you want to do is to wait for the break of the neckline. Here it comes. The market breaks this neckline or even this neckline. It doesn't really matter. And then after the neckline break, you want to wait for the pullback. So the market pulls back here with a bull bar. And then you want to trade when you see a good signal bar. And then the signal bar comes. This bear bar is not a very good signal bar because the body is too small and tail is too big. However, the next bear bar is a very good signal bar because the body is large and then is leaning towards the bottom. So you can enter at the bottom of this bear bar. Or you can wait a little bit to see even when the market breaks the bottom of this whole bear bar or the whole consolidation here. Whichever way it works. In terms of the protective stop, right after you enter the market, you want to specify that on your chart. There are a few options. The first option is top of the pullback. Basically, here's the top of the pullback. If you cheat, the top of the pullback is here, this bull bar. The second option is the top of the right shoulder. This is the right shoulder, so you want to put the stop at the top of the shoulder. The third option is maybe a few tips above the left shoulder, since left shoulder is lower. So basically here. A good option is you put your protective stop as close as to the bear bar or bull bar close. It really depends. Here you can see that you can use the close of either this bull bar or this bear bar. In terms of the profit targets, there are also a few options. The first option is to use N time sell risk. This N is based on your study of the backtesting of the historical chart. You can choose between 1 to 2 for scalping, and you can choose any other number as well. So take this for example. The actual risk should be at the top of the pullback, which is the top of this bull bar. And then let's assume that you enter at the bottom of this bear bar, so you measure between the stop and your entry. This is your actual risk. And then you measure down, one-time risk, you will get out at this level. Basically, this bull bar is going to trigger your profit target. If you measure for 2 times of your risk, you will get out at this level. Basically, you will be getting out at this bull bar. You can also choose any other number. However, the probability if you choose the number larger than 2 is very low. The second option is to use the measured move of the previous leg. So here is the previous leg. You want to measure from the top of the first bear bar until the bottom of the last bear bar. This is the distance that we are expecting the market will go the same downward. Then you measure from the top of the pullback here for the same distance. So this is the level for your profit target. You can see that this bull bar will trigger your profit target. You can also do the swing because there are multiple legs here. However, the swing probability will be low. That is because basically here is the first leg. This is the head. This is the right shoulder. And then this is the second leg. If you enter here, that means you are trading for the third leg down. So the third leg normally has a lower probability than the second leg. And then if you swing from here, that means you're expecting the fourth leg. Fourth, fifth, or even later legs has a very, very low probability. So that's why you don't want to swing. A lot of times, before you even see the head and shoulders pattern, other patterns already giving you a good setup. Let's take this chart for example. If we use the method to trade the neckline break, we have the head and the 2 shoulders here. And then we have the neckline. This is the neckline because the right shoulder pushes higher than the left shoulder. And then we are waiting for the market to break this neckline. Eventually the market breaks with this good bull bar here. And then we are waiting for the pullback. The next bar is a bear bar, which is the pullback. Then we wait for a very good signal bar to enter the market. This bull bar is a very good signal bar because it has a strong support. Then we enter the market at the top of this bull bar. This is the traditional neckline break trading. However, before the neckline break for the head and shoulders, we already have a very good setup for the trendline break. Let me show you. So basically, we can see that there is a high here, there's a lower high. We can draw a line for the trend line here, even before we see this left shoulder and the head. And then we are waiting for the market to break the trend line. So you can see that the market breaks the trend line with 3 consecutive bull bar here. The break is very strong. And then for the trend line break, we wait for the pullback and then trade the pullback. Then here comes a very good signal bar, this bull bar. It is a very good signal bar because the body accounts over 60% of the whole candlestick. So that's why we can put our buy order on top of this bull bar to enter the market. So comparing the trend line break and the neckline break for the head and shoulders, you can see we enter the market much earlier than the head and shoulders. Here is the enter of the trendline break, and then here is the enter of the neckline break for the head and shoulders. So basically the trendline break is much preferable. Let's have a look at the protective stop if we choose the trendline break rather than the head and shoulders. So there are a few options. The first one is to put at the bottom of the pullback. You have a very tight risk, but you have a higher probability of getting stop out. The second is to put at the bottom of the head. You have much room for the trend to develop before it takes off. However, you will have a higher risk. Or you can choose anywhere in between. Now let's have a look at the profit target. It's the same thing. We have a few options. The first one is to scalp for the end time of your risk. Basically, we can measure from the bottom of the pullback to the top of the entry. And then we measure up for 1 time of a risk. You will get the profit target at this level. 2 times of the risk, which is here. Or you can use the measure move of the previous leg. So here, you can measure from the bottom of the head until the top of the first leg end, or you can choose the consecutive bull bars to be conservative. It really doesn't matter that much. And then you measure from the bottom of the pullback for the same distance, so you will be getting your profit target at this level. The third option, you can also use the previous high, low, or any other support or resistance levels that is suitable for you. Basically, we have a previous high based on the previous chart, and then you can set your profit target at this level. You're getting out with this big bull bar. The last option is to swing. Because this is possible, you enter the market earlier here than the head and shoulders pattern here. That's why you can swing. So this is the first leg, this is the second leg, and then this is the third leg. So you can swing until you see the end of the third leg. Now let's have a look at the continuation pattern. Take this chart for example. Here we can see there's a head and 2 shoulders. However, the issue for this head and shoulders is that first, it's part of the trend. We have a very big downtrend here with a very tight channel. And also the head and shoulders here, the range is very small comparing to the whole chart here before it. So for this head and shoulders, basically there's no trading meaning. You don't need to trade it, or you cannot trade it. It's going to give you a stop out with higher probability of that. As the market develops, you can notice another head and shoulders. Basically, here's the head and here are the shoulders. We're still in a downtrend. And then the head and shoulders is with the same direction as the downtrend. The thing for this is that it's part of the trend as well. And the range is big enough. You can see that from the bottom of the shoulder here until the top of the head, the range is big enough comparing to the downtrend previously. However, the chart is very choppy. You see a lot of overlaps here. Whenever the chart is too choppy, you can move to the upper time frame. The previous chart is a 5-minute chart. So this chart is a 15-minute chart. You can see the downtrend is clearer than before. What we can do is that first you can see this is the leg down here, and then you want to wait for the pullback. So the whole thing here, the head and shoulders here, becomes a pullback of the downtrend. And this pullback is very obvious. And then basically when the market pulls back here, you can draw a line. So this is the previous pullback. If you treat this doji bar is the pullback of the downtrend. That means the market is testing the previous pullback, but it failed, so the downtrend will resume. So this is a very good opportunity for you to enter when you see this bear bar that indicates the downtrend will continue. However, in this chart, you don't see clear head and shoulders anymore. Now let's have a look at the entry on both charts. Basically, we want to trade the upper time frame as the pullback rather than head and shoulders. So when you see the market comes back to test the previous pullback high here, you want to wait for a good signal bar on the 5-minute chart. So this bear bar is a very good signal bar. You can enter here. or you can wait for another small pullback and then enter at this bar. So this bar is also a very good signal bar. This is the 5-minute chart. Let's move to the 15-minute chart. The same thing, after the pullback, you see this very good signal bear bar. So you enter upon the close or even the bottom of this bear bar. You didn't get hit by the next bull bar if you enter at the bottom of this bear bar. However, you will enter at this bear bar. Or you can even use this bear bar as another signal bar to add your position. And then after the market goes down, there's another pullback. You can also add to your position at this pullback. This bear bar is a very good signal bar as well. So 3 entry signal bars are all good options for you. Now let's move on to the last part of the video. Let's see some trading examples. Take this chart for example. Let's do some preparation. We have the level of PP here. And then we can also draw a trend line. And then, so we can see the market develops and following the trend line. However, at this moment, the market breaks the trend line before we even see any other pattern. And then for the trend line break, we trade for the pullback. When the market pullbacks here, we can enter the market. However, right after we see this pullback, we identify that it is a head and shoulders. This is the head. These are the shoulders. And then the market moves down again. So basically this PP line is also the same as the neckline. When it breaks the PP line here or the neckline, and then we wait for the pullback. Here comes the pullback. We can trade here. Or if it pulls back again, we can trade here as well. Basically from this example, you can see even if we don't have the head and shoulders here, we can still trade. For this break, you can trade breaking the PP line, or even if you can trade like the second pullback here, ignoring this PP line. Now let's take a look at this example. Again, we draw the levels. PP level, and this level is the previous day's low. Again, the market moves, respect this PP, and then moves and break it. And then right now it breaks down again here. So that will give us a good opportunity after the pullback. And then here comes the pullback. You can see that the market respects this PP level again and then pulls back. So we trade at the pullback here with this very good signal bar. And then right after we see the pullback, we identify that, okay, it's another head and shoulders. So we draw the line for the neckline here. And then the market breaks the neckline. And we can trade after the pullback comes. Here is the entry. However, the difference between this example and the previous example is that in this example, this neckline with this head and shoulders pattern can confirm the entry of this. So it will increase the probability of this entry. Though it is not necessary, it is not materially increasing the probability, but have another confirmation will build up your confidence. Now let's have a look at this chart. So when the market comes down here, we can see the head and shoulders pattern, though it is not that perfect. And then we'll wait for the market to break the neckline. I didn't draw here, but should be somewhere around here. And then we trade for the pullback. We can go long here. However, when you take a closer look at this chart, you can see we have a support level 1 here. This support level 1 serves as the confirmation for the upward trending or the reversal trending. That is because this level is respected by the market. The market pushes 3 times down here but didn't break it and then reverse. So with this support 1, we have more confidence and higher probability that when we enter here, it's going to go up. So it's going to give us a successful trade. Now let's have a look at this example. Similar to the previous example, at the PP level here, we have the head and shoulders pattern here. So this increased the uptrend reversal because of the PP level. And then the market goes up, pulls back. This is a very good trend bar. We can enter at the top of this trend bar. Though it comes back again, then we can re-enter at these 2 good signal bull bars here. And then as the trend develops, we can draw a trend line because we have a low here and a higher low. And then when the market touches the trend line for the third time, there's another good opportunity for you to go long. So you can just enter the market along the trend line. There are multiple opportunities. However, there are a few things for this chart. The first thing is that when you see the whole chart here, you can see that the head and shoulders here is a very small part of the whole trend. We can see that this is the first leg up rather than a clear head and shoulders. And then we pull back, the second leg up, pull back, and third leg up. Another thing is when the downtrend here is very weak, and then the uptrend here breaks a little bit higher to test the previous high here, that we can expect the market can go even further to the top here, like testing the R1. So the downtrend weak, the uptrend could be strong. Let's have a look at this chart. So basically we have two levels here at the top and at the bottom. Because the market respects the level multiple times, so that's why I draw the level here besides the PP level. You can see that the market is in a trading range between these two levels. And here we have the head and shoulders pattern here. But the head and shoulders pattern here is only part of the whole screen. This is what I meant by part of the whole screen. That means the probability of this reversal is low and it's not gonna go very far because it's only part of the whole day trading range. It is very hard to trade trading range like this. For this chart, as the market develops, you can see a head and shoulders here, though not perfect. Then you can choose to trade the neckline break here, that you can see the market goes down. However, as the market develops, you can see another head and shoulders here. It is the different direction with the first one. If you choose to trade this time, when they break the neckline here, you can see the market didn't go up even further. Instead, it comes down to give you a stop out. So basically, this is the understanding of the chart here. Basically, here we can see at the start of the day, we have a strong breakout with 4 consecutive bull bars. That means for the whole day, the buy will have a higher probability, the sell will have a lower probability. So when you see this head and shoulders, probably you don't want to trade at this pullback. However, when the market comes down here, why it stops here? Because it is testing the R1 level, or if it is testing the previous pullback here. But it didn't succeed, so it goes up. And then when it pulls back again, so you can enter here to expect the market to go up to test the previous high again. So this entry has the highest probability comparing to this and comparing to this. On some days, we'll see multiple head and shoulders because the market is very choppy. So take this chart for example. We have a head and shoulders here. We also have head and shoulders here, here, and also here. If we take this, the shoulders, we can also see this is the head and 2 shoulders. However, the head and shoulders here won't work that much. Instead, the correct trading is for the trend line trading. Basically, we can draw a trend line when we see this low and this higher low. And when the market comes down to test the trend line for the third time, this is a very good long opportunity. So you should go long here. And then when the market comes down to penetrate the trend line here, you want to trade the pullback. So here is the trend line break opportunity. Take a look at this chart. We also have multiple head and shoulders, but not all of them are tradable. Basically, we want to see the big picture. We want to see the big waves. How we see the big waves? Remember how we define the uptrend and downtrend. If we have higher highs and higher lows, we are in an uptrend. If we have lower highs and lower lows, we are in a downtrend. Here we have a low, we have a high, we have a higher low, and then we have a higher high. And we have another higher low and higher high. Higher low and higher high. So you can see these are the waves. So you want to trade with the waves and then ignore the small waves between it. Basically, this is the leg, this is the pullback, leg, pullback, leg, pullback, and the leg. If you enjoyed my video, please don't forget to subscribe, like, and comment. You can also go to my channel for more videos. Thank you. In day trading, some setups look very good, and after you enter your trade, it didn't go your direction, but rather it gives you a stop out. These are called traps. In this video, I'm going to show you how to identify the traps and how to avoid some of them. Let's get started. I'm going to cover the following topics. Number 1, bull and bear traps basics. Number 2, the traps in day trading. Basically, there are two types of traps, avoidable and unavoidable. Number 3, I'm going to show you some day trading examples. What are the bull and the bear traps? Basically, they are seemingly good setups that lead to losing trades. Here, the setup means all the setups from your strategy. Take this chart for example. In this chart, we have a trend line here, and then there's a trend line break. For trend line break, the trading strategy is we wait for the pullback. These two bull bars serve as the pullback, and then we trade for the signal bar. Then here comes the signal bar. This bear bar looks very good because the tail is at the top, which means the resistance, and the body is leaning towards the bottom. And then we enter at the bottom of this bear bar. Then after the market moves to the downside, we move our stop to the top of the pullback. So here is the total risk between the stop and the entry. If you choose to scalp, then we can use 1 time or 2 times of the risk as our profit target, or anything between 1 or 2. So if we use 1 time of the risk, here is the exit, which is the profit target. In terms of the scalping, I have a video in my channel that shows how to choose the scalping strategy and how to choose the risk and reward ratios. Later on, the market didn't hit the profit target here. Instead, it goes up to hit the stop. So this trade becomes a losing trade. So this setup is a bear trap. In this case, the market eventually goes down. However, in other cases, the market can go up. Now let's move on to the second part of the video, traps in day trading. Basically, the traps can be classified into 2 categories. The first one is avoidable traps. For these traps, we can develop or update our strategies to avoid them. The second is unavoidable traps. So this is part of the game. Basically, your strategy is based on the statistics. For example, you have 80% of the time, the setup will give you a winning trade. And then this 20% refers to the unavoidable traps. Take this chart for example. We have a trendline join here, and then we have a trendline break. For the trendline break, we wait for the pullback, which is this bear bar, and then we trade upward accordingly. We go long when we see this doji bar or this bull bar. However, the market didn't go up any further. Instead, it goes down to give you a stop out. So this is a bull trap. Basically, the issue for this bull trap is that the break for the trend line is not very strong. We can revise the day trading strategy to avoid these traps. So there are a few options. The first option is, for the break, we want to see it's breaking the previous major highs. In this example, there's a major high here. If we draw a level at the top of the major high, then we want the market to break the trend line and also break the previous major high, so the trend is strong enough. Then we can enter after the pullback. This will reduce the probability of the losing trade and increase the winning ratios. The second option is, if there's a trend line from the other side of the trading range, then we can use the width of the trading range as the measurement. For example, here we have this trading range, and then we measure from the top of the trading range to the bottom of the trading range. This is the width. And then we want the market to break this trend line and also break half of the trading range, so we are convinced that the break is strong enough. In this example, we measure from the point of the break, and then half of the trading range width. So if the market breaks this level, that means the break is strong enough. This will also reduce the probability of losing trade. The third option is we want to wait for the consecutive bull bars to be convinced for the strong breakout. In this case, we can see there's only one bull bar breaking the trend line here. That is why the break is not strong enough. Take this chart for example. Again, we have a trend line, and then we have a trend line break. This trend line break is very strong because it is breaking the previous major low here and also even here. And then we wait for the pullback, which is this bull bar. And then here comes the signal bar, which is very strong. And then we enter at the bottom of this bear bar. However, we can see the market didn't go down even further. Instead, it goes back to the upside. The reason that the market stops going even further, it is because there is a level, which is an overnight support level. This is the picture for the whole trading day. On the left, it is the overnight chart. We can see that previously there's a low, and then the market goes to test this low for the first time. And then these two lows define a support level. And then when we enter the trade, the market is right at this level. This is a strong support level. That is why the market didn't go down even further. So from the big picture here, we can see the whole day is a trading range day rather than a trend day. For these types of traps, we have two options. The first option is to study the context. Basically, we need to focus on the picture of the whole day rather than part of it. In this case, the whole day is a trading range day. For trading range, the characteristic is the probability of either upside or downside will be reduced greatly. So that's why we need to be careful in trading the trading range day. The second option is to add necessary support and resistance levels. The previous day's high-low, previous high-low in the same day, the pivot levels can all serve as support and resistance levels. When the market moves to the levels, we need to be very careful in observing the behavior of the market before we decide the direction. So in terms of the support and resistance, I have another video in my channel you can refer to. In this example, we have consecutive bars. That means the strong breakout. Here we have 5 consecutive bear bars, 3 here and 3 here. So for the strong breakout, we want to trade for the pullback. So here is the pullback with 2 consecutive bull bars. And then here comes the signal bar. This signal bar is very good because the body accounts over 60% of the candlestick. And then we enter at the bottom of the bear bar. However, we can see the market goes up instead. So this becomes a bear trap. The reason for this bear trap is because when we enter the trade, it is already too late. It's already in the end of the trend. To avoid this type of traps, we need to understand the market. In this chart, we have the first leg, and then the second leg, and the third leg. So the probability for the second leg down has higher probability, and then the probability for the third leg is reduced. Normally, the fourth, fifth, or even later legs has very, very low probabilities. So the solution is we trade only the second or the third leg, or even we only trade for the second leg, which has the highest probability. Another solution is to rate the market carefully, especially we want to understand the price action and see any clue. So again, the first leg here, we can see there's a big tail in this bear bar. This means strong support. That means the market strength to the downside is already reduced. For the second leg, in the middle, we can see there's a bull bar as the pause of the trend. This also is a sign of the weakening of the downtrend. And in the third leg down, we only see 2 bear bars here, rather than 3 like before, or even 5 in the first leg. These are all the signs for the weakening of the market. That means later on when we do the trading, when we see this setup here, the probability will be reduced greatly. We have seen some examples of the avoidable traps. Now let's move on to the unavoidable traps. In this chart, we have a trend line and then a trend line break. This trendline break is very strong, and then we wait for the pullback and trade for the signal bar. However, we can see the market didn't go up even further. Instead, it goes down. So this is a trap, and then this is a reversal of the trend. However, in reviewing the whole setup, there's nothing wrong with it. So this is part of the game. And then if the trendline break here gives you the 70-80% of the winning probability, then this setup, these traps, are the other 20 to 30% of the probability of the losing trade. So this is part of the game, and then it is unavoidable. Here's another example. We have a support level here, and then the market breaks the support level. Similar to the trendline break, we wait for the pullback and then trade when we see the signal bars. So here comes the first bear bar, which can serve as the signal bar because the tail at the top is very big, which means resistance. Or we can trade another bear bar here. Both are very good signal bars. However, the market didn't go down for the second leg. Instead, it strongly break up to the upside. And then there's no previous support level at this area. So there's nothing wrong with this setup, and then it's purely just a probability of the losing trade. For this kind of trap, it's really hard to avoid. Here's another example. The market forms an open triangle to the downside. And then when the market goes up here to test the trend line for the third time, we can go short. Because for the trend line support or resistance, the market has 60 to 80% of the time it's going to respect the trend line and then bounce back to the trading range. However, in this example, there's no follow-up going down to the other side of the trend line. Instead, it breaks the top trend line to the upside here. So there's nothing wrong with this setup as well, because the third touch of the trend line gives the highest probability the market will go back to the trading range. It's like 60 to 80%. But in this example, it didn't go down further. It belongs to the other side of the 20 to 40% of the trading range behavior. So this trap is unavoidable. Now let's move on to the last part of the video. Let me show you some trading examples. In this chart, we can see the market strongly breaking out to the downside. And then at this moment, we have two consecutive bull bars, especially the second bull bar is very strong, breaking to the upside. So if you choose to wait for the pullback, this bear bar, and then wait for another good signal bar, bull bar, and then trade upside, then this will become a bull trap. That is because based on the whole chart here, the downside breakout is very strong. So that would take a lot of effort for the buyers to reverse the trend. So here, even though there's a possibility that the market will go up, but the probability will be reduced. It seems that 50-50 would be a very good estimate here. In this example, the market goes down and then reversed. So if you think that the market will continue to go up, and then here's the pullback, and then you enter when you see these two bull bars, then it becomes a bull trap. That is because, like I said, the previous high-low are very important levels. And especially for this example, previously overnight, the market didn't move much, so the whole area here becomes the support or resistance value zone. So when the market goes back to this zone, rather than a single level, we should watch the market behavior. Another thing is, the market is already in the up leg, the end of the trend. That's why this, if you enter here, it becomes a trap. In this example, the market forms a trading range here, and then we have a trendline break to the top. So when we enter here, this is a legitimate bull trap because the market goes down. However, when the market goes up again here, and then it pulls back, if you enter here, this becomes another bull trap. The reason for this bull trap is because, take a look at the whole chart here. Do you have a strategy to deal with this chart? If not, then you shouldn't be entering here. Even if you see very strong breakout here, this bull bar is super strong, but it doesn't mean that there's a follow-up. In this chart, we can draw a trend line here. So the market is making higher lows and higher highs. And then when the market goes down to touch this trend line again, So if you enter at this moment to go long, then it becomes a bull trap because the market goes down later on. And then when you see the market breaks out here very strongly and then pulls back and then you enter short here, then this becomes a bear trap. Again, take a look at the whole picture here. Basically, the whole day is a trading range day, and then the market is bouncing between these two levels. So that's why even when the market goes to the one side of the trading range, we need to be very, very careful in entering the trade because the market could go either way. In this example, we have a trend line and then there's a trend line break. However, the market goes very choppy at this area. So when the market goes down again here to test the trend line again, if you enter here, this will become a bull trap. So normally the trading strategy allows you to trade the trend line break, pull back when it tests the trend line again, or the support resistance level when they break and then test the level again. However, in this case, you can see the market becomes very choppy here, which is a good indication of the trading range behavior. So when you take a whole picture of the whole day, you can see that again, the whole day is a trading range. So that's why that in the trading range, we need to be very, very careful in entering the trade, either side. In this example, the market breaks the trading range here and then goes to test the support level 1 here. And then the market has a big, strong bull bar, which shows the upside pressure. But when you enter the market here, it becomes a bull trap because the market goes down even further later on. So in this case, basically we shouldn't be entering here. That is because seeing the whole chart here, previously the market has a breakdown to the downside and then trading range and then to the downside. We didn't see any sign for the reversal of the trend. So that is why you shouldn't be entering here. This is a bull trap. In this example, the market goes down and then enter into a trading range. And then when you see this bear bar, then you enter to the short. However, it becomes a bear trap. Instead, the market goes up. And then when the market goes up to test this level, support level 1, and then pulls back with this good bear bar, and then if you think it's a very good opportunity to short again, and then this becomes another bear trap. Basically, after the market has a breakout and then enter into a trading range, so the direction to either upside or downside will have 50-50. We want to see the market breaks each side of the trading range to decide the direction. And then also for the support level 1 here, we didn't see its very strong support level based on the previous chart here. So that is why these two becomes very good example of the bear traps. In this example, the market goes down for the first leg, pulls back, and second leg. When it pulls back again, here comes a very good signal bear bar. If you enter here, this becomes a bear trap. The market goes up instead. And then when the market goes beyond support level 2 here, and then it pulls back, and then it didn't go down even further, when you see this bull bar, if you enter here, this becomes a bull trap. So that is because if you take a look at the previous chart here, we have the low here. So if you draw a level here, we can see the market has been within this range between this low and also the S2 here for quite a while. So these two levels comes the value zone. So that's why when it gets into the value zone, you need to be very careful when entering your trade. Here's another example of unavoidable bull traps. So basically on this chart, we can see there's a huge breakout with this huge bull trend bar. And then when the market pulls back here, and then with another signal bar, you can enter here. However, the market didn't go up, instead it goes down. And then here comes another pullback, and then gives you another good signal bull bar. And then you enter again. Then the market goes down to reverse the previous bull bar. So this becomes the bull traps. So these bull traps are really unavoidable because there's nothing wrong with the setup. If you enjoyed my video, please don't forget to subscribe, like and comment. You can also go to my channel for more videos. Thank you.